Good evening, my dear students. Hope all of you are doing fine. And hope all of you have covered all the sessions till now, which were held on the indirect tax laws. If you all remember, I had covered the introduction chapter, the taxable event chapter, the exemptions chapter, concept of GST and the charge of GST, post which you would have you would have attended the sessions of the concept of the place of supply. And so now we come to another very interesting topic, very important from the examination point of view. And also this is one topic which is also very relevant in the practical circumstances. As in, any person who is running the business who has a GST registration will always have his questions based on the input tax credit only. So therefore, in the practical scenario also, it is a very important topic. Examination scenario also very important topic. Multiple amendments have been carried out in this particular concept. What are all those amendments? What are exactly the provisions? We will also cover certain rules which are associated with regard to these provisions. All this we will see in the coming 3 hours of our session. So before that, again, I hope all of you who are attending this session have attended the previous classes. If this is your first session, I would seriously suggest you to first attend all the previous sessions and then attend this one, because a lot of interlinkage will be there, and the topics what we are going to cover are are associated with all the other sections what we have discussed in the previous sessions. So without wasting much time, let us straight away get into the chapter. I hope everyone have their respective good evening Shriram, good evening Viraj, good evening Kaushiki. I hope everyone have the respective study material and the also the notepad ready. Wherever I tell you to please make a note, kindly please make a note of what we are discussing, the important points. So therefore, why is this input tax credit very essential? First of all, what is the concept of input tax credit? Can anyone tell me? We discussed in our first session with a few examples. What is the concept of input tax credit? What comes first to your mind when you hear the terms input tax credit? Please type in the chat box so that I see your views. What comes to your mind when I say the word input tax credit? So therefore, in the previous, again, prior to 2017, a lot of deficiencies were there in the indirect tax system, wherein a lot of taxes used to happen, used to be imposed, like central excise, service tax, VAT, etc. And on those taxes also other taxes used to be imposed. Like a small example is excise duty was applicable on the manufacture of products prior to 2017. So the moment you have a factory, and the moment you are into an activity of manufacturing, when the goods are removed from the factory, you have to pay the excise duty. So the cost of the goods included the excise duty also, which used to be somewhere around 12 to 13%. And after that good comes out and it is for sale, again on that value, the VAT used to be applicable, or central sales tax used to be applicable. So therefore, the concept of tax on tax was there, due to which the cost of production, the cost of any particular business used to increase. This was the pure deficiency in the input tax system. Yeah, so input tax credit to avoid cascading effect. Okay, tax paid on inward supplies incurred by the entity. Very correct. Okay, set off liability, reduce liability. Yeah. So the main concept of input tax credit, my dear students, is that whatever tax you pay on any particular business related expense, you need to have the facility of adjusting that when you are making the payment to the government. So so if you take a small example here, now you have assuming you are into the business of buying and selling watches. You have a watch showroom, and for the showroom you pay rent. On that you pay the GST. You also hire a digital marketing person to do various ad campaigns on Facebook, Instagram, etc. On that, whatever they charge for the marketing, on that you pay the GST, right? So all these, if you see, are pertaining to the business. So whatever GST you pay on that, you can claim that as a credit. So if you are paying 1 lakh to a digital marketing person, 18% GST, 18,000 will be the credit. Similarly, if you are paying 2 lakhs rent per month, 18% on that, 36,000 will be your input tax credit. So this 36,000 plus 18,000, that is 54,000, will be sitting as a credit in your GST portal. And when you sell the watches, you of course collect the GST from the customer. In 1 month, you have sold watches worth 50,000 or 1 lakh rupees. You have collected 18% GST. Some watches is also 28%. Let's assume 18% for our example. And 1 lakh worth watches means 18,000 you collect from the customer, which you are supposed to pay to the GST. But you have 54,000 worth of input tax credit. So therefore, you need not pay anything to the government. You will straight away set off that. That is the main concept of your input tax credit. So here the most important point, therefore, is that whatever input tax credit is there, you can claim, and this you can use for the purpose of paying the GST what you're collecting from the customer. That is the basic concept of input tax credit. Now, because of this, if you observe, prior to GST and post GST, definitely there will be a multiple cost reduction for the businessman, because now he's getting the benefit of input tax credit on all the business expenses. Earlier, that was not the situation. So therefore, here the important point what the government insists is, since you are getting more benefit of the input tax credit, you need to pass on the benefit to the ultimate customer by way of reducing your prices, right? So here in this example, if you see, you have an input of 54,000, but you have to pay only 18,000. So therefore, you have this excess credit of 54 minus 18,000, which is 36,000. So this 36,000, you have to pass it on to the customer by way of reduced prices. This is the intent of GST, so that the ultimate product or service becomes more cheaper for the individual consumer, right? So therefore, due to these various deficiencies in the system, which is prior to 2017, this input tax credit was introduced. The state against central tax set-off was not available. If you see, earlier VAT was there, which was a state law. So within the state, if you are selling, VAT was applicable. Between two states, if you are selling, CST, central sales tax, was applicable. So whatever VAT you are paying on the purchases, you could not set off that against the CST what you are collecting on the sales. So therefore, since this set-off was not available, because of this, lot of cost was getting burdened. The businessman was being burdened with extra cost. So therefore, in this GST, that is why the main marketing strategy of GST is the seamless input tax credit. That is, input tax, if you are paying for the business purposes, you will get that input tax credit, as simple as that. So therefore, to avoid the cascading effect of taxes and to make the GST a destination-based tax, that is why this input tax credit scheme is there. So mainly the input tax credit, if you see, it is available of inputs, input services, and capital goods, which is used for the purposes of the business of a taxable person. The most important point, all of you please bear in mind, that input tax credit you can use. The fundamental condition is that it has to be used for the purposes of the business. You purchase, you are purchasing some soft drinks, you are purchasing an ice cream which you are consuming yourself. Is that for your business? You may have a GST registration, but if you go and buy an ice cream from a particular shop, that is not related to your business in any manner. So therefore, you cannot claim that, right? So main important point is inputs, input services, whatever input tax credit is there, if it is used for the purpose of a business of the taxable person, you can claim. The exception is blocked credit. What do you mean by blocked credit? There are certain particular items which we are going to discuss during our session. Those particular expenses, you cannot claim the input tax credit, even though they are used for the purpose of the business, right? This is the main condition. So blocked credits are there. That means expenses on those particular items, you cannot claim, even though they are used for the purpose of the business. That is why the blocked credit is clearly given. And then GST law, another important point is, it does not require one-to-one correlation between inputs, input services, and final products or services. That means, earlier what was the situation? You are purchasing a particular item. This item, you are adding some margin and you are selling that item. One-to-one correlation. So this particular input, you can claim. But any business expenses apart from that, you cannot claim. Therefore, one-to-one correlation is not required. You can sell anything what you want. But You're in the business of selling textiles, selling furniture. You can sell anything what you want and collect GST from the customer. Input tax credit you will get on all expenses which are used for business purposes without any restriction. There is no need of any one-to-one correlation saying that this particular product only has to be sold, only then the input will be given. Nothing of those sort is there. So one-to-one correlation is not required. Another important point. See, if you see, what are the types of supply? Taxable supply and exempt supply. If you are into a supply of a product which is chargeable to GST, you are supposed to collect the GST from the respective customer. The moment you collect the GST from the respective customer, since the output supply is taxable, so whatever you are collecting on that you can avail the input tax credit. But what about an output supply that is exempt? There is no question of input tax credit. What does this mean? Exempt supply. In exemptions chapter, we discussed multiple goods or services are there which enjoy the exemption under the GST law. So when if this particular taxpayer is in the business of supplying the exempt goods or services, he has a GST registration. He cannot claim the input tax credit of anything, because against what will he use the input tax? Because there is no output tax what is collecting from the customer. Since there is no output tax what is collecting from the customer, there is no use of claiming this input tax credit. That is why ITC is not available. Please make a note, everyone. Input tax credit is not available when the tax is not payable on output supply. Right? Input tax credit is not available when the tax is not payable on output supply. That is on exempt supply. So if the person, the taxpayer is in the business of running the exempt goods or services, he will not get any input tax credit. However, there is an exception to the above rule, which is the zero rated supply. Now, let me take you to what exactly is a zero rated supply. If you see, there is exempt supply, which we have discussed at length in one chapter, and there is zero rated supply. Exempt supply and zero rated supply. So if you see zero rated supply, what exactly it is? Exports of goods or services and supplies to special economic zones, right? So these are specifically given as zero rated supply. In the chapter of exports and zero rated supply, place of supply also this point maybe have touched upon. Export of services and supplies to special economic zones. We have seen what is special economic zone very clearly last time. So you should by now know what exactly is a special economic zone. So therefore, in this zero rated supply, the main important point is you have two options. You have two options. Okay. Option one is with the payment of tax, and option 2 is without payment of tax under LUT, letter of undertaking. I'm slowly digressing to the zero rated supply, because only then you'll understand what exactly it is. So therefore, if you are into an export of goods or service, or you are supplying to a special economic zone, it is a zero rated supply as per the provisions of the IGST Act. So the moment you are engaged in a zero rated supply, that is, you are exporting the goods or services, the government, the GST rule law gives you two options. First one, you export with payment of tax. In option 1, you export with payment of tax. That is, you collect the tax and from the respective customer. Then it is very much the same. Anyways, input tax credit will be available. Option number 2, you export without payment of tax under LUT, letter of undertaking. That means you need to execute a letter of undertaking, or it's an online application what you file with the President of India, saying that you are into pure export of services and you need not collect the tax, and you need not collect the respective tax. Just one moment, my system is troubling a bit today. I hope my screen is visible. System is, the icons are opening by itself today. I don't know, for some reason, right? So therefore, options without payment of tax under LUT, this is the second option. So therefore, the important point for you to note down is ITC is available. ITC is available in both the above options. So you may get a natural question. Sir, if you are not paying any tax, how will you adjust the input tax credit? If you're not paying any tax because it is a zero rated supply, if you opt for option 2, which says that you don't pay any tax, how do you adjust the input tax credit? You adjust the input tax credit by way of claiming refund. So therefore, if option number 2, if without payment of tax you're executing under letter of undertaking, what you will do is you will claim a refund by, you can claim the input tax credit, but you can't adjust it against any liability because it is a zero rated supply. So you will claim the respective refund. Yeah. So that was the concept of zero rated supply. I hope you understood what exactly is. That is an exception of what we are discussing, zero rated supply input tax credit. Please make a note of this. Input tax credit is available with respect to zero rated supply. Zero rated supply, you can write in the bracket, export of goods or services or supplies to special economic zone. What are the sections which govern the ITC law? Section 16 to 21 of the CGST Act 2017 and Chapter 5, that is Rules 36 to 45, prescribe the provisions relating to input tax credit. State GST laws also prescribe the identified similar identified laws. So therefore, if you see here, there may be a situation. What is the situation? The first situation, if you see, a taxable person is making both taxable and exempt supply. Okay. In that case, what has to be done? This is a situation which is very common. You may be an institution, you may provide exempt services, and you may provide taxable services also. Many such examples I can. If you see, if you look at, let me take an example, plastic surgeon. Plastic surgeon is there. He is operating a clinic where he does plastic surgery to improve the face contours and of the patients. Now, if you have an accident wherein, for example, you lost your nose is totally gone because of the accident. You go to the plastic surgery for the reconstruction of the nose. So that is for getting back the anatomy. We saw it in exemptions also. If for getting back the anatomy of the body, if you go and get the service done from a plastic surgeon, it is an exempt supply. But for cosmetic improvements, like you want to sharpen the shape of your nose, you want to do something to your face for looking more attractive, that is not a compulsory thing. It is a voluntary thing. So that is again a taxable supply. Now, so this is a classic situation where the taxpayer is making both the taxable supply as well as the exempt supply. So what do we do in that particular situation? First of all, if you are able to clearly identify this input are used only for taxable supply. For example, if that person is doing a plastic surgery for improving the facial features, okay, for more cosmetic rather than medical in nature, in that particular situation, you can claim whatever, if you are able to identify the inputs very clearly, what you are utilizing for the taxable supply, you can claim the entire input. Now, for the medical purposes, plastic surgery, if you are able to identify the inputs or input services which are used exclusively for that exempt supply, then you cannot claim. That is what he says. So therefore, a taxable person is making both taxable and exempt supply, full credit of ITC in respect of inputs, input services and capital goods used exclusively for taxable supply, and no credit at all for inputs, input services and capital goods used exclusively for exempt supply. That is the most important point here. We have to keep it in mind. Now, if you see, common inputs, input services and capital goods are used for taxable as well as exempt supply. Only proportionate ITC attributable to taxable supply is available. So what does this mean? If you have common inputs, input services and capital goods, common items are there, which is used for both taxable and exempt supply, only proportionate ITC you can claim. How you have to calculate the proportion ratio of value of taxable and exempt supply? For this, many provisions are given, which we shall discuss at length. This is just for you to understand as to, in this particular situation, how to claim the input tax credit and how to apportion the input tax credit. We shall discuss those particular rules very, very clearly. Now, also another important point with regard to inputs and capital goods sent for job work. What is job work? Can anyone tell me? What first comes to your mind when you hear the word job work? When you hear the word job work, what comes to your mind when you hear the word job work? Why this special treatment in case exports and supplies were ITC available for refund instead of lapsing? The main important the benefits why it is given to the exporters is because moment any amount comes in foreign exchange into the country, the value of the rupee strengthens. Okay, since the value of the rupee strengthens, economically it makes more beneficial to the country. So that is why the country always encourages exports and discourages imports, right? For imports, lot of customs duty and excess taxes are levied. But with regard to exports, since foreign currency is being brought into India, the value of the Indian rupee increases because of this. So that is precisely why in this particular situation, the benefit like a refund, etc., is zero rated supply is given. Sending goods to job worker for doing treatment and process on the product. Yeah, that is correct. This is what is given. But what is the process of job work? Why is the word job work given such a big importance in the GST law? The main important point here to understand is when you give to a person for job work, why do you do that? Because that same process you also can do. Okay, same process you also can do, but you don't want to do that because you feel that if you outsource it to someone else, it makes more economic sense. So therefore, that is where the job work comes into the picture. So if you purchase a particular item, let us assume you are purchasing diamonds, you are purchasing raw diamonds, then you are giving it to the job worker for the purpose of polishing and cutting the diamonds. He does that work and sends it back to you. Fine, that is your job work. Now, there may be a situation. You may purchase it, you need not, the diamonds need not come to you. You may tell that particular seller, you directly send to the job worker's premises. Practically, this happens. So what happens to the input tax credit in that particular situation is also clarified. So therefore, in this particular situation, even if the inputs and capital goods are sent directly to the job worker without being first brought to the place of business of the supplier, still the input tax credit can be claimed. Still, the respective input tax credit can be claimed. Also, input services received at head office or branch office are ultimately indirectly used for supplies made from manufacturing or trading of business premises. ITC of such input services can be availed through mechanism of input service distributor. What is input service distributor? In brief, whenever there is a business with more than one registration, that is, you have multiple branches throughout the country. In that particular situation, what happens? There may be particular expenses, common expenses which are incurred. An example is if you have offices in Bangalore, Delhi, Mumbai, Chennai, 4 locations you have the offices. In this particular situation, you incur the expenses in the incur internet expenses. You hire a broadband provider who provides the internet to all these 4 cities. So therefore, in this particular situation, all the 4 cities can claim the input tax credit on a proportionate basis. So who does this division of credit? Input service distributor. We shall discuss this concept also. Input service distributor means it is very much the taxpayer himself takes another GST registration. In that GST registration, he will specify very clearly that is an input service distributor, and whatever input tax credit, common input tax credit accrues to the organization, he will divide that respective input tax credit across all the respective branches which has the GST registration. I hope this point also is clear. So some definitions before we go to the main section. Capital goods. Why is the definition of capital goods very, very important? First of all, what is capital goods which comes to your mind? Immediately you will recollect the balance sheet assets side, fixed assets column. It is very much the same definition. Capital goods, why it is important to be defined under the GST law? Because input tax credit of capital goods are also being allowed apart from inputs and input services. So when I say inputs, that means the material purchases, what is being resold, and some other items with regard to the same. When I say input services, it means the rents, for example, renting of immovable property, that is one, digital marketing is one. Those are input services. Capital goods means like furniture, air conditioners, etc. These are capital goods. So therefore, in this particular situation, capital goods earlier in excise duty, they had a very, very elaborate definition of capital goods. But in this particular situation, it is more, the definition of capital goods is more simplified and pretty much covers everything. That therefore, goods which are capitalized in the books of accounts, as simple as that. Any goods which are capitalized in the books of accounts of the person claiming the ITC and which are used or intended to be used in the course or furtherance of the business. So therefore, you have to examine whether he is capitalizing that in his balance sheet, and also the second point is to examine whether he is using it in the course or furtherance of the business. You either using or even intended to be used in the course or furtherance of the business. Same way, definition of input also is important. Goods other than capital goods used or intended to be used by the supplier in the course or furtherance of the business. Again, input also, it's a very, very vast definition. He is covering everything other than capital goods. So that itself shows what is the kind of coverage the word input has. So all the goods other than capital goods used or intended to be used by the supplier in the course or furtherance of the business. Input service means what? It means a service used or intended to be used by a supplier in the course or furtherance of the business. So any service is there, you are using the service or intended to use the service in the course or furtherance of the business is your input service. Then we just discussed input service distributor. What exactly is that? It is also defined by virtue of 2 subsection 61. Office of the supplier of the goods or services which receives the tax invoice issued under section 31 towards the receipt and issues a prescribed document for the purpose of distributing the credit of the central tax. So this definition is exactly what meaning, what illustration I explained 10 minutes back. So if you have multiple offices, you have a common expenses, you have to take a registration as an input service distributor. This input service distributor will distribute the respective input tax credit across all the branches. And then 2 subsection 62 defines the term input tax in relation to a registered person. Means what? The central tax, sale tax, integrated tax on any supply of goods or services to him, and includes all these particular taxes. So therefore, if you see the word input tax, okay, what all does it include? First of all, it is the CGST, SGST, IGST. This is very, very clear. And it includes what all? IGST paid on import of goods. So on import of goods, customs duty is applicable. And apart from customs duty, you have the IGST also, which is applicable. So IGST also is an input tax with regard to import of goods. Apart from customs duty, IGST also is charged. So this IGST also is an input tax on import of goods. Then the tax payable under the provisions of 9.3 and 9.4. Now I will not tell you what these provisions are. You should know what these provisions are, because we discussed these particular provisions in very, very elaborate manner in the chapter of charge of GST. So if anyone doesn't know what these provisions are, you have either not attended the classes, or even if you have attended the classes, you have not revised properly. So I will not tell what is this 9.3 and 9.4. You need to remember for sure. Basically, it is the tax on the reverse charge. What is there? That is also input tax, because you can claim that also as a credit. Tax payable under the provisions of subsection 3 and 4 of section 5 of the IGST Act. This is the same as section 9, 3 and 4, but the provisions of IGST Act, they are accommodated in section number 5. Similarly, tax payable under the SGST law 9394 of the SGST Act, or tax payable under 7374 of the Union Territory GST Act, but does not include the tax paid under the composition levy. This is a very, very important point. What is composition levy? Again, I'm not going to tell anything. We saw this also in charge of GST. So in composition levy, that 1%, 2% or 5% or 6% on services what we are paying, that you cannot claim the input. So therefore, it is excluded from the definition of income tax also. So it does not include the tax which is paid under the composition levy. Nice to see everyone recollecting the reverse charge. But what is there in the provision also you should remember. Okay, 263 is very simple definition. Input tax credit means the credit of input tax. What is input tax? We have seen in the previous definition. Then tax invoice or invoice means the tax invoice referred to in section 31. This section 31 you will see in great significance in time of supply chart, right? So as like that's also a simple definition. Then 2 subsection 67 defines the term inward supply. What is inward supply? In relation to a person shall mean receipt of goods or services or both whether by purchase, acquisition, or any other means, with or without consideration, right? So in relation to the person, what is inward supply? Receipt of goods or services. So if you are receiving the goods or you are receiving the services by way of purchasing them, by way of acquiring them, or any other means, with or without consideration, that is known as a inward supply. And then 2 subsection 68 defines the term job work. What is job work? It means treatment or process undertaken by the person on goods belonging to another registered person, and the expression job worker shall be construed accordingly. Main important significant part of the definition of job work is it will come under the job work for the purpose of GST only if the treatment or process is done on the goods belonging to a registered person. So important point is, if a registered person gives it to someone for doing any treatment or process, only then it will be considered as a job work from the GST point of view. That is your 2 subsection 68. Then manufacture definition we have already seen before also. Processing of raw material inputs in any manner that results in emergence of new product having distinct name, character, and use. Right. So whatever work you're doing on the raw material, because of that raw material or inputs, a new product has come out. This new product has a distinct name, character, and use. That is your manufacture. Again, 2 subsection 76 defines the term motor vehicle. Again, this is not very important from the examination point of view. If someone, again, why this definition is important from the GST law, why is it defining motor vehicle? Because it is used in blocked credits. Okay. So motor vehicle means same vehicle as assigned in 228 of the Motor Vehicles Act. You can Google and see or read through the definition. It has 4 wheels, motor, and all of that. So that is the definition which is given. Then non-resident taxable person means what? This also we have covered before. Non-resident taxable person and casual taxable person. Non-resident taxable person means person who occasionally undertakes the transactions involving the supply of goods or services or both, whether as principal or agent or in any other capacity, but he has no fixed place of business or residence in India. Fine. So who occasionally undertakes the transactions involving supply, whether as principal or agent, no fixed place of business, he comes and does the business, he is non-resident taxable person. Non-taxable supply also is a very, very simple definition. Any supply of goods or services which is not leviable to tax or under the IGST Act is a non-taxable supply. Output tax, again, the tax on the supply of the goods or services. In relation to the taxable person, tax chargeable under the Act on taxable supply or both or agent, but excludes the tax payable by him on the reverse charge basis. So why does it exclude the tax payable on reverse charge? Because this tax on reverse charge is covered in the definition of input tax. That is why this one is excluded here. Outward supply in relation to taxable person means what? Supply of goods or services or both, whether by sale, transfer, barter, exchange, license, rental, lease, disposal, made or agreed to be made by such person in the course or furtherance of the business. Again, the same way of supply concepts, what all are there, are mentioned here. 2 subsection 83. Then definition of zero rated supply is given in 16 subsection 1 of the IGST Act. Again, please note down this. Section 16 subsection 1 of the IGST Act 2017 defines the term zero rated supply. This is very, very important. Okay. Only IGST, it is not a definition under section 2, but straight away defined under section 16 subsection 1 of the IGST Act. So what is zero rated supply? It means any of the following supplies of goods or services or both, namely export of goods or services or both, or supply of goods or services or both to a special economic zone developer. Or, as I told you, this is a definition of the zero rated supply by virtue of section 16 subsection 1 of the IGST Act. Now we come to section 16, eligibility and conditions for claiming or taking the input tax credit. Again, now we are back to CGST Act also. So this 16 subsection 1 refers to the CGST Act 2017. Any queries till now? So that before we proceed further to the respective sections, please let me know, because from here the understanding becomes very, very important. So section 16 refers to eligibility and conditions for claiming the input tax credit. 16 subsection 1, every registered person, important point, registered person. That means who can claim the input tax credit? Only if you are registered under GST. Only they can claim the input tax credit. The first words itself proves the same. Every registered person, okay, every registered person shall subject to such conditions and restrictions as may be prescribed and in the manner specified in section 49. Therefore, every registered person shall subject to the conditions and restrictions as may be prescribed. So there is a condition as such as may be prescribed and in the manner specified in section 49. Manner specified in section 49, how to claim the input tax credit, that also is given, right? So therefore, that is an important point. Be entitled to take credit of input tax charged on any supply of goods or services or both to them, which are used or intended to be used in the course or furtherance of the business. So therefore, subject to the conditions and in the manner specified, he can be entitled to credit the input tax which are used or intended to be used in the course or furtherance of the business. So what are the important points in 16 subsection 1? Please remember the important points. This one is first one, conditions and restrictions as well. First one, the person have to be registered. Please make a note. Section 16 subsection 1, important points. Number 1, the person needs to be registered. And second, the goods or services should be used or intended to be used in the course or furtherance of the business. The word intended to be used is very, very significant. That means you have purchased one, say, technical equipment, okay, which you are supposed to use, but you have not yet started your business operation, but you purchased and kept. You can claim the input tax credit. It is not necessary for you to actually put to use. The intention of putting to use is enough, right? And the said amount shall be credited to the electronic credit ledger of such person. So when I say electronic credit ledger, what does it mean? In the GST, there are 3 ledgers: electronic cash ledger, electronic credit ledger, and electronic liability ledger. So credit ledger is whatever credit you take on the procurement or the purchase, you straight away gets accumulated in the electronic credit ledger, and you can use that against the GST payment. So this electronic credit ledger is maintained online once you log into the GST website, right? So that is your 16 subsection 1, which talks about the claim of input tax credit, right? You can claim, registered person, use or intended to be used in the course or furtherance of the business has to be there. Now we come to 16 subsection 2. Notwithstanding anything contained in this section, no registered person shall be entitled to the credit of input tax in respect of the supply of, unless, now this is a very, very important section from examination point of view, because multiple changes have occurred in this particular sections. Basically, you can say 16 subsection 2 talks about the conditions for claiming the input tax credit. Conditions for claiming the input tax credit, very, very important from examination point of view. Okay, why it is important, that also I'll tell you, because in supplementary, please, if possible, please get your supplementary study paper also separately along with you when we are discussing this. I've taken all the amendments and put it in this slide itself, so for you to easily refer. I've also given some examples as to the new concepts which are there, which are examples are not there in your supplementary paper. I have devised some examples and given here for you to understand better. So therefore, kindly pay attention to 16 subsection 2. Few queries here. Sir, you said that elsewhere VAT system does not allow credit of central tax with CST. In GST law also GST. I didn't get the point. Erstwhile, okay. Now you can claim here also. Here also CGST. See, here the important point is the tax is divided into CGST and SGST. So your input tax is CGST, SGST. Output tax is CGST, SGST, or sometimes it can be IGST. That set off can be done. Only CGST cannot be set off against SGST. But that situation is very rare. It doesn't come because most of the time CGST, SGST will be here. CGST, SGST will be here also. Fine. So therefore, the credits what can be claimed in GST is much more than what it was under the VAT law. Yeah, now we come back to section 16 subsection 2. Notwithstanding anything contained in this section, no registered person shall be entitled to the credit of any input tax in respect of any supply of goods or services or both to him unless. So no registered person shall be entitled to ITC unless, first one, he is in possession of a tax invoice or debit note. What is a debit note? Sometimes when you procure some products, there is a shortfall in the product and he has to give further products. So instead of raising another invoice, he will raise a debit note to that extent. So therefore, invoice or debit note both has to be there. Issued by the supplier registered under the act. Again, invoice issued by anyone is not correct. The person who is issuing the invoice has to be registered under GST, right? Or such other tax paying documents as may be prescribed. Second condition, he has received the goods or services or, right? So this person will get the input tax credit only once he has received the goods or received the services. For the purpose of this clause, it is deemed that there's an explanation given to the above clauses. It is deemed that registered person shall receive when goods are delivered by the supplier to the recipient or any other person on the director of the such registered person. This is your bill to ship transaction. You must have seen in place of supply chapter. Now, what happens here? Sometimes I may not receive the goods. Let me give you an example. I am a dealer in Hyderabad. I am purchasing from a particular dealer who is in Bangalore and I'm selling to the customer who is located in Indore. Did you get the point? I'm located in Hyderabad and I'm procuring from a person located in Bangalore and I'm selling to a particular person located in Indore. So here what I say is, rather than you sending the goods to Hyderabad, you send it directly to Indore. That is what I'm telling the Bangalore. So therefore, in that particular situation, even though I am physically not receiving the goods, if once the goods directly go to Indore, it is deemed as if I am receiving the goods. This is what is the explanation which is given here. So therefore, when you say received of the goods, sometimes the purchaser need not receive the goods. The goods will go directly to the seller's office from the supplier's office. I need not even receive the goods for that matter. So the moment it goes to the other customer's office, it is deemed as if I have received the goods for the purpose of section 16. I hope this point is clear. Continuation. Subject to the provisions of section 41, the tax charged in respect of such supply has been actually paid to the government either in cash or utilization of ITC admissible in respect of such supply. 41 talks about methods of payment of tax after the eligible set off of CGST, SGST, etc. So therefore, you have to stick to the provisions of section 51 when you are actually setting off the GST against input and against the output GST. So subject to those particular provisions, the tax in respect of such supply has been actually paid to the government, okay, either in cash or through utilization of credit available. So therefore, if you see here, whatever tax you are charged in respect of the supply, you are actually paid to the government, and he has furnished the return under section 39. Section 39 talks about the multiple returns. This is where the amendments have happened. What are the amendments which have happened? I will tell you. So here, he has furnished the return under section 39, provided that where the goods against an invoice are received in lots or installments, the registered person shall be entitled to take credit upon receipt of the last lot or installment. So wherever the goods are there in the invoice, I am receiving those goods in lots or installments. The moment I receive the entire last lot or installment, only then I can claim the input tax credit as per 16 subsection 2. Then there is another provision which is given. Sometimes what happens, I procure the goods, but I don't pay it to them. I procure the goods from the particular supplier. I claim the input tax credit, but I don't pay to them. What is to be done in that particular situation? That is what is dealt by this particular provision. Provided further, where a recipient fails to pay to the supplier of the goods or services or both, okay, where recipient fails to pay, he does not pay, other than the supplies on which the tax is payable on reverse charge basis, okay, where recipient fails to pay to the supplier, other than the reverse charge basis. Reverse charge is separate because I have to pay directly to the government. The amount towards value of the supply along with the tax payable within a period of 180 days from the date of issue of the invoice by the supplier, an amount equal to the input tax credit availed by the recipient shall be added to the output tax liability along with interest thereon in such manner as may be prescribed. So what does this mean? Now, I purchased a particular point. Let us take an example otherwise to help you understand better. See, here Mr. A purchased goods worth rupees 1 lakh from Mr. GST at the rate of 18%. Okay, date of invoice raised by Mr. B was 20th March 2023. Now, Mr. A claims the ITC. Okay, condition is he has to make the payment within 180 days from date of invoice. Fine. So therefore, what is the ITC? ITC is rupees 18,000. Okay. Now let us assume. Actually, you have to count the exact number of days, but for simplified and easy purposes, let us assume 4, 5, 6, 7, 8, 9. 20th September is a lapse of 180 days. For example, so September 20th. So let us say Mr. A makes the payment on 20th December 2023. So here what happens? Once September 20th is elapsed, okay, Mr. A has to reverse the ITC what was claimed. Okay, so he has claimed this 18,000. He has to reverse that respective ITC. That is what has to be done. He has to reverse the input tax credit, and also interest shall be applicable here in this particular situation. Interest on what will be applicable? Interest from, okay, 20th March to 20th December needs to be calculated. Not 20th March, technically he has to, 20th March is the date of invoice. He has to pay the GST by 20th April. You'll see the dates of payment of tax in our accounts and payments of tax chapter. So this 20th April to 20th December interest needs to be calculated and paid by Mr. A. So that is exactly what your provision talks about. Okay, I hope everyone are clear with this particular example, right? So that was your provision. The next last provision, provided also recipient shall be entitled to avail the credit on payment by him of the amount towards the value of the supply along with the taxpayer. Very simple. Now, whenever he makes the liability, that is in our example, he made the liability payment on 20th December. So the moment he makes the payment on 20th December, at that point of time, he can claim the input tax credit. Fine. That is an important point. Now, sir, in case where one says to other says also is zero rated supply. Yes, very much a zero rated supply. Usually it's a very uncommon occurrence. One says supplying to another says is like you can say out of GST only, because both are technically located outside the country, right? So it's not a zero rated supply. You can say it is an exempt supply only altogether, because it is not technically the territory of India. Can we claim credit of GST cess? GST cess credit you cannot claim. It is not allowed. But if you have corresponding input and output cess, input cess is there, output cess is there, that you can adjust against each other. Otherwise, you cannot claim. Do practically we look for the conditions goods are received where supplier bills but good delivered and received. See, technically, as I told you, GST is a self-assessment tax. That particular it says that you have to receive the goods, but whether you have actually received the goods or not, you only know. You have to claim the input tax credit based on the section, right? So whether you are receiving the goods or not, only you will know. So you should go as per whatever is the fact of the case. Fine. Now, let us look at these amendments. Very, very important point. Addition of clause AA to section 16 subsection 2 and addition of clause BA to 16 subsection 2. Now, what does it say? Input tax credit in respect of any supply of goods or services is available to registered person Only if the details of the invoice has been furnished by the supplier in the statement of outward supplies GSTR1 and such details have been communicated in the manner given under section 37. Now, for this to understand, I have to first take you to this evolution slide and then we'll come back to this particular point. Yeah, first let you understand. Let me put you to this as to what exactly are we talking about here. You understand these concepts, then you will see. I am slowly again digressing to return step because only if you understand that you will try to get it. So what exactly happens? See, every taxpayer who is registered under GST, I'm only going to talk about the common returns which are there, not about all the returns. Okay. The common returns which every taxpayer requires to file on a monthly basis is your GSTR1 and your GSTR3B. GSTR1 needs to be filed by the 10th of the succeeding month and GSTR3B needs to be filed by 20th of the succeeding month. So what happens? Let us take an example here. Now, I purchase, this is that example. During December 2022, supplier A having GST number of so and so makes a supply of goods worth 15 lakhs to supplier B having GST number of so and so. CGST and SGST 9% are applicable. CGST is 1,35,000, SGST 1,35,000. The supplier A has to file the GSTR1 on January 9th, that is before January 10th. What is GSTR1? GSTR1 basically talks about the sub sales which have been made by the supplier for the tax period. So here in December tax period, he has made a sale worth 15 lakhs. So on this 15 lakhs plus the GST, I will show it in my GSTR1, which I filed before on Jan 9th, 2023. What happens to this is, the moment I file before the due date, to my supplier B, there is an auto-generated form which is known as GSTR2B. Auto-generated form which is known as GSTR2B. In that, this recipient can see what is the credit which he can claim. Did you understand? So this 1,35,000, whatever is filed there, in supplier B, he can see in his GSTR2B that 1,35,000 should appear. Only if it appears, he can claim the input tax credit. Very, very clear. This is what that rule means. I hope you understood. Okay, once I file GSTR1, the details will be available in the GSTR2B of that other particular recipient. Once he can see that, only then he can claim the respective input tax credit. Immediate, another important point. If you file the GSTR1 date, same example, instead of filing on January 9th, he filed on January 12th. The input will not be reflected to him in GSTR2B on 13th. So therefore, in that particular situation, the input can be claimed only next month because it will get updated in the GSTR2B of January 2023. I hope you got the point. That is basically your new rule which has come. Let us go back to, that is your clause AA. So therefore, whatever GSTR1 is filed, if it is visible, I get to claim the credit. If it is not visible, I cannot claim the credit. Very, very simple. So therefore, an important point is the question whether you can claim the input tax credit or not, and the chances whether you can claim the input tax credit or not is totally dependent on your customer filing the respective GSTR1. If GSTR1 is filed, you can claim the input tax credit. Otherwise, you cannot claim the input tax credit. It's very, very simple. But the pain point here, the risky point here is that you are dependent on your customer in this particular situation for claiming the input tax credit. Fine. I hope this point is clear. So only if he files, or not the customer, the supplier, if he is selling to me, so he has to show in his GSTR1, it will be visible to me. Similarly, another clause BA is been updated here. Again, it is a similar provision. Whatever input tax credit is there, it can be claimed only if the credit has not been restricted. That is, it has to be visible in the portal. Okay. So if it is not visible in the portal, if it is restricted from being given in the portal, you cannot claim the input tax credit. That is your 16 subsection BA. So the 16 to AA and BA are important from examination point of view. 16 subsection 3 talks about when you claim depreciation, what is the situation? Very, very simple. It says that if a registered person, if he has claimed depreciation on the tax component of the cost of capital goods and plant and machinery under the provisions, the input tax credit of the tax component shall not be allowed. So if you are claiming the depreciation, you should claim it only on the taxable value. If you are purchasing a machinery worth 10 lakhs plus 18% GST, the total comes to 11,80,000. You have to claim the depreciation only on 10 lakhs. If you claim the depreciation on 11,80,000, you cannot claim the input tax credit in GST. This is what is the provision of 16 subsection 3. Very, very simple provision. The 16 subsection 4 also, there has been an amendment here. Earlier, this particular date was September. Now it has become November. That means what? 16 subsection 4 lays the condition and the timeline within which the respective input tax credit can be taken. Okay. 16 subsection 4 gives the timeline within which the respective input tax credit can be taken. So therefore, very simple. A registered person shall not be entitled to input tax credit in respect of any invoice or debit note for supply or both after 30th November following the end of the financial year to which that invoice or debit note pertains, or furnishing of relevant annual return, whichever is earlier. So therefore, there is a due date which is given in this particular situation. For each financial year, you cannot take the input tax credit after 30th November following the end of the financial year. So therefore, if financial year 22-23 is there, April 2022 to March 2023, if you have any purchase invoice or expense invoice on which you have not claimed the input tax credit, there is a timeline given for you to claim the input tax credit. You can claim up to 30th November or the date of furnishing the annual return, whichever is earlier. Fine. 30th November or date of furnishing the annual return, whichever is earlier. This is what is the due date which is given in this particular situation. Fine. Any doubts till now? Yeah, due date is 11th of the succeeding. Correct. We need to take ITC as per 2A, 2B, 2A. 2B is the form on which you can claim the ITC. 2A will get updated regularly. 2B will get updated only once on 13th. So whatever is there in 2B only then you can claim. For 2A, you can see the values keep changing again and again. So 2A, the next month, the same thing will get updated in 2B. That time claim as per 2B and file the return. I hope it is clear. Fine. Now we go to rule number 36, which talks about the documentary requirements of input tax credit. So input tax credit shall be availed by the registered person on the basis of the following documents. Invoice issued by the supplier in accordance with the provisions of 31. So as per 31, he has to, all the invoice details has to be given. Invoice, if it is issued on the basis of that, he can claim the input tax credit, or invoice issued in accordance with 31(3)(f), subject to the payment of tax. Debit note, bill of entry, in case of integrated tax on imports, input service distributor, that is a credit note, etc., as per the provisions of sub rule 1 of rule 54. So these are the documents on the basis of which you can claim the respective input tax credit. Also, input tax credit should be availed only if all the applicable particulars are contained in the said document. This was there before, now it is no longer there because there is a separate rule which is added with regard to display of information in GSTR 2B. So this particular line was not needed, so they have removed it. So therefore, only if in the document all particulars like name of that person, GST number, address, HSN or SAC code, all those have to be there, only then the credit can be claimed. But sometimes there is a proviso which is given if the said document does not contain all particulars but contains the details of amount of tax, description, total value, GST number, place of supply. In such cases also, the input tax credit can be availed by the registered person. So therefore, the provision gives a certain relaxation that all information need not be there, still we can claim the input tax credit. 36.3, no input tax credit shall be availed by the registered person in respect of any tax that has been paid in pursuance of any order where the demand has been confirmed on account of fraud, willful misstatement, or suppression of facts. That is, with respect to tax that has been paid in pursuance of the order. So wherever there is an order with regard to fraud, willful misstatement, etc., on the basis of that order, you have paid the respective tax. In that particular situation, there won't be any input tax credit. In case there is any order which levies any demand, if you're paying the demand of tax, on that basis, input tax credit shall not be claimed. Fine. This is the amendment again, Rule 36.4. Very, very important critical rule, subject to a lot of changes. This rule number 36 subsection 4. I will tell you how it all started, the entire history of how it is there once we come to the end of this discussion. So Rule 36.4, what does it say? No input tax credit shall be availed in respect of inputs or invoice, the details of which are required to be furnished under section 37.1, which is nothing but the GST return, unless the details of such invoices or debit notes have been furnished by the supplier in the statement of outward supplies in GSTR1 or using invoice furnishing facility. Now, what is this invoice furnishing facility? Can anyone tell me? Anyone who have done their articles properly and filed the GST returns will be able to answer this. Can anyone tell me what is this IFF? Invoice furnishing facility. If we not claim ITC till due date, then it will lapse. No, it won't lapse. It will, you can, if you have to claim, I'm sorry, what it should be there as per 2B, you have to claim in your 3B. Once it comes to the credit ledger, it will not lapse. But if you don't claim it, then automatically it will lapse. If R1 of Jan is filed after due date, then recipient shall not be claim ITC, assuming, yes, correct. The recipient cannot claim the input tax credit. So what is IFF? Can anyone tell me? Very good. In case it is under QRMP scheme, then it needs to be filed. Very good, very good. That means you have learned. No, it's not invoicing, Kaushik. Invoicing is different. Okay. So therefore, good. That means only person who has done practical training in GST can answer this. So therefore, for dealers whose turnover is less than 1.5 crores, if they want, they can opt to file the GST returns on a quarterly basis, monthly payment. That is, monthly you have to pay the tax, but GSTR 3B, you can file on a quarterly basis. For such persons, since they file the returns 3B on a quarterly basis, there is no way of disclosing the invoice in the GSTR1 because GSTR1 is not there on it. So therefore, in place of GSTR1, the government has given an optional facility of IFF, invoice furnishing facility. So you can furnish the invoice in that, due to which it will automatically be generated in the GSTR 2B of the corresponding party, and you can claim the input tax credit. So therefore, even if you are opted for the quarterly return monthly payment QRMP scheme, it is very, very critical that you have to file the IFF in case of B2B invoices. Only then they will get the respective credit. So therefore, that was your IFF. And the details of input tax credit in respect of invoice have been communicated to the registered person in form GSTR 2B under 67. Very simple. He has to file the return. Whatever return he has filed, it has to be visible in the form GSTR 2B. Fine. So that was your rule number 36. Very important rule with some new changes which have been made. Now, Rule 37 talks about the reversal of credit. Again, this I told you, if 180 days you have not paid, you have to reverse the credit. That is what is given in this Rule 37, what we discussed just half an hour back. So 37.1 talks about registered person who has availed the ITC on any inward supply of goods or services but fails to pay to the supplier the value of the supply along with the tax payable within the time limit. That is nothing but 180 days. Then what he will do is he will furnish the details of the supply and amount available, whatever input tax credit is available, he will reverse that for the month following the period of 180 days from the date of issue of the invoice. Fine. This GSTR2 is not relevant. Only thing is whatever he has claimed the input tax credit, he has to reverse that and pay the interest. Fine. And provided that the value of supply is made without consideration has been as specified in Schedule 1 shall be deemed to have been paid for the purpose of second provision. Sometimes what happens, you also make the supplies without consideration. The moment if you make without consideration in that particular situation, it is deemed to be paid because free samples are there. So these free samples you distribute. If you distribute to other than related or distinct persons, still you can claim the input tax credit. Then, provided further value of the supply on account of amount added in accordance with provisions of clause 15 subsection 2 of section 15 shall be deemed to have been paid for the purpose of the second provision. Sometimes what happens, as per value of supply section 15, with regard to the main purchase price, also another amounts also will be added by virtue of 15(2)(b), whereas it can be like freight or any reimbursement of expenses, installation charges, etc. So therefore, for the purpose of this second provision of 16 subsection 2, these items also shall be deemed to have been paid. Then what happens, 37(2), whatever input tax credit which you are not filed after not paid after 180 days shall be added to the output tax liability for the month. I also gave an example on this particular rule. And of course, the registered person shall then be liable to pay interest at the rate notified under 50 subsection 1 for the period starting from the date of availing the credit till the date when the amount is added to the output tax liability is paid. We discussed this just recently. Again, the time limit will not apply to re-availing of the credit. So therefore, any credit which has been reversed, the moment it is re-availed, then you can claim the input tax credit. There is no time limit for that one. So let us go through what all we have discussed now. Registration is mandatory for taking the input tax credit. As I told you, only a registered person can be entitled to the ITC of the GST charge on inward supply, subject to the provisions relating to use of ITC under section 49. Section 49 talks about who the ITC can be used, which we will discuss also. So based on those subject to those provisions, you can claim the input tax credit. Then the goods and services are to be used for business purposes only. So this ITC will be available on the goods or services which are used in course or furtherance of the business. For definition of business, you know, it is a wide definition. The relation of input need not be one-to-one correlation. It can be direct or indirect. Okay. Now there is a clarification which is given by the GST department, which talks about the molds and dies provided by the original equipment manufacturer. What is this molds and dies? There will be some accessories which are to be used in the manufacture of product. Like if any person is manufacturing a mobile phone, sometimes in the components with regard to the mobile phone, like for example, Apple is there. Apple gives the job work of developing components to some other person. So Apple is the original equipment manufacturer, whereas the component manufacturer is a person who actually just does the manufacture of the components and accessories which are used inside the phone, right? So in that particular situation, whether it is to be considered in the course or furtherance of the business, where original equipment manufacturer is giving to the component manufacturer free of cost. So what happens? So here, molds and dies, the clarification what was given. The molds and dies owned by the original equipment manufacturer, which are provided to the component manufacturer, both are not being related or distinct persons. If you are giving free of cost, it is not a supply, as there is no consideration. So OEM manufacturer, OEM gives the components, the molds and dies. Molds and dies are nothing but the small things which are used in the job work or the this process. So if he gives it free of cost, it is not a supply because there is no consideration. Also, since these molds and dies are provided on free of cost basis in the course or furtherance, no requirement of reversal of ITC. These molds and dies are purchased by equipment manufacturer. They are sold, they are given free of cost to the component manufacturer for the purpose of making the final equipment. So here, since he has purchased it for his business and he is given it free of cost to a person other than the relative or distinct person, then there is no question of reversal of ITC since it is in the course or furtherance of the business. But sometimes what happens, there may be a contract between the original manufacturer and the component manufacturer for supply of components by making molds and dies belonging to the component manufacturer, but the same have been supplied by the OEM to the component on free of cost basis, right? So therefore, what does this mean? It says that in this particular situation, the OEM gives the contract of supplying the components to the component manufacturer. In this particular situation, OEM does not purchase the molds or dies. Molds or dies are belonging to the component manufacturer. Component manufacturer, it belongs to him. The same, the molds or dies which is belonging to him are supplied free of cost to the component manufacturer in that particular situation. I hope you got this point. See what is happening here. Let me give you with an example otherwise. One is the OEM. Okay. Here, what is the OEM doing? He is supplying to component manufacturer free of cost. Okay. So what does the component manufacturer do? Okay. So here the contract is for supply of components using the molds or dies belonging to the component manufacturer. Okay. So here OEM is supplying the component manufacturer, but here it is the main important point is the molds or dies belong to component manufacturer. So what is happening here? This OEM procures the molds or dies and supplies to component manufacturer free of cost. So once it does this, the molds or dies automatically belongs to the component manufacturer. In that particular situation, the OEM needs to reverse the credit. So here what it does, once it procures the molds or dies, here I'll write in the bracket so no confusion, claims the credit and supplies to manufacturer. Here molds or dies belongs to the component manufacturer. Here the OEM needs to reverse the credit. Why it needs to reverse the credit? Because the same will not be considered to be provided in the course or furtherance of the farmer's business. Okay, this is an important clarification which is given. So this OEM procures it and gives it to him, but it is not in course or furtherance of the business because the main contract is supply of components which is to be made by the component manufacturer to OEM. So OEM procures the molds and dies, gives it to the manufacturer free of cost. Whatever credit it claims, it has to reverse, and it has to reverse because it is not to be considered in the course or furtherance of the business. These molds or dies are given because the contract of supply of components is given to the component manufacturer. Therefore, this first point and second point difference is important to be understood. Circular number and date need not be remembered from examination point of view. I told this point before also. I have written so many in my exams when I've written and qualified my CA examinations. You may believe it or not, I have not written a single section number also. Leave alone the circular number. Section number itself I have not written. You remember what is there in the section, that itself is important enough. But what is there in the section, you have to remember correctly. That is a very, very important point here. It is convenient of recipient to avail the ITC. It is definitely convenient, but that person has to file the input tax GST return or IFF. Okay, so 16 subsection 2, what are the 4 conditions? Possession of the tax paying document, okay, invoice issued, debit note issued, bill of entry, revised invoice, document issued by input service distributor, Based on this, you have to claim the input tax credit. As I told you, with effect from 1st January 2022, new clause has been added. ITC can be claimed only if a detail of invoice or debit note has been furnished by the supplier in GSTR 1 or IFF for that matter, and such details have been communicated. Okay, so therefore rule 36.4 has been substituted to that effect. So what is the new rule 36.4 say? No ITC can be claimed unless the details have been uploaded in GSTR 1 or AFF. The details of ITC have been communicated in GSTR 2B. ITC can now be taken only with those invoices, the debit notes whose details are reflected in GSTR 2B. When it will be reflected? When the respective suppliers or vendors file the invoices in GSTR 1. And then new clause BA has been added to another new condition. It provides that ITC in respect of any supply of goods or services is available to a registered person only if the details of ITC in respect of the said supply communicated to that registered person has not been restricted. Means what? You can claim the input tax credit if whatever the details are there with regard to the supply, the communication of the details to the supplier is not restricted. That means very simple. He has to first file the GSTR 1. That is first one. Second one, once he files GSTR 1, it has to reflect in the 2B. So what is exactly happening? The communication of the details is happening. So that communication of the details should not be restricted. That is what is given. Fine. So what are these three returns you have to understand? GSTR 1 is a monthly or quarterly statement. Considering the details of outward supplies, they are communicated, made available electronically in GSTR 2A or 2B. 2B is an auto-drafted ITC statement, whereas 2A is not, it is also automatically updated, but it keeps updating every now and then. Whereas GSTR 2B is updated only once on the 13th of the succeeding month. Auto-drafted ITC statement generated for every registered person based on the GSTR 1 filed by the supplier. IFF or invoice furnishing facility is provided to the quarterly taxpayer who are in the QRMP scheme to file the details of the outward supplies in first 2 months to pass on the credit to the recipients. This example we have already seen. I hope all of you understood very clearly what exactly is this example. And a few other things: no ITC of tax paid towards demands involving fraud. Any tax is paid where the demand has been confirmed on account of fraud, willful misstatement, or suppression of facts. You cannot avail the respective input tax credit. Also, GSTR 1, whatever is there. Why exactly this has come? Many taxpayers take inflated or bogus input tax credit. Fake invoices will be there. They'll claim the input tax credit. To exercise control over that, the restriction has been placed. So ITC on all invoices or debit notes which are there uploaded in GSTR 1 can be availed in full. The recipient gets the details of the tax invoices in their GSTR 1. Okay, example here, try to answer this. Atlas Private Limited is a manufacturer of taxable goods. It has received 50 invoices for inputs and input services from various suppliers during the month of September. Invoices involve ITC of 5 lakhs. Suppliers has filed in their GSTR 1s for 40 invoices involving ITC of 3 lakhs. What is the ITC available for Atlas Private Limited? Try to answer this question. Yeah. So therefore, only 3 lakhs will be available. Why 3 lakhs will be available? Because he has filed only for GSTR one of that. So only that will be available in the GSTR 2B. So therefore, only that can be claimed. Okay. So all 4 conditions should be satisfied. The person should receive the goods or services. Bill to ship model also covered. The goods are delivered to the third party on direction of the registered person. That also is covered. So receipt of goods of 16 to be including delivery on the direction of the registered person. Registered, it should be deemed as if he has registered the goods in such scenario. So ITC will be available to the registered person on whose order the goods are delivered to the third person. A is a trader who places an order for B on consignment of soda ash. A receives a buying order from C for the same quantity of soda ash. A instructs B to deliver the goods to C and he raises an invoice on C. So if you see here, though it is not physically received at the premises of A, the condition is satisfied and A is eligible to claim the ITC on the consignment. Then registered head office of ABC enters into a contract with DEF for repair and maintenance of computer systems installed at the registered branch office. DEF issues invoice on ABC Private Limited for services provided by it. Now, this is related to the input service distributor. In case here, he can claim the input tax credit, but wherever branch offices are there, this input tax credit should be passed on by way of a credit note to all the respective branches. Tax should have been paid by cash or utilization of ITC. Even if the recipient has paid the tax, his claim gets confirmed only when the supplier deposits the tax. So collect. The tax has to be deposited by the supplier to the government. And then the registered person should have filed the return under section 39. Presently, summary return in GSTR 3B is being filed on a monthly basis. Therefore, the taxpayer has to also file it on a periodic basis. Then first provision, in case the goods covered under invoice are not received in a single consignment, are received in lots or installments, the ITC can be taken only upon receipt of the last lot or the installment. Only then you can claim. This is also an important point which you have to remember. Another example here, XYZ enters into a contract with ABC for supply of 10 metric tons of a chemical of 1,18,000. Chemical is to be delivered in lots over a period of 3 months. ABC raises the invoice for entire amount in August. XYZ also makes the payment in the same month. Supply is completed in November. Now, as I told you, whenever the goods are supplied in lots or installments, it is important that he can claim the input tax credit only upon the receipt of the last lot. Okay, so after 3 months, whenever the lot is received, only then the input tax credit can be claimed. Then payment for invoice is to be made within 180 days. The value of the goods or services along with the tax within 180 days he has to pay. In the event of failure, we have discussed this also. Interest rate is 18%. 18% is the interest rate which will be applicable per annum here in this particular situation. Once payment is made, the credit can be availed. Part payment entitles to proportionate credit. Again, here this 180 days condition does not apply in the following situations. The supplies on which the tax is paid under reverse charge, deemed supplies without consideration, additions made to the value of supplies on account of supplier's slab. In these cases, this 180 days point will not apply. We have discussed these provisions. We are just summarizing and revising these particular provisions. This also is a very, very simple point. Wherever the depreciation is claimed on the tax component, the ITC cannot be allowed. The person is taking ITC on capital goods, plant and machinery. On the tax amount, if he has claimed the depreciation, you cannot claim the input tax credit. So therefore, dual benefit, the conclusion here is dual benefit cannot be claimed both under income tax and GST law simultaneously. Either depreciation can be claimed or GST can be claimed. So a registered supplier purchased machinery for business purpose, value of machinery is 10 lakhs and GST paid is 1.8 lakhs. In this particular situation, he can claim the input tax credit only if he claims the depreciation on 10 lakhs. If he claims the depreciation on 11,80,000, he cannot claim the respective GST as an input tax credit. Then time limit for availing the ITC also is given. Due date of filing the return for the month of September. You please ignore the September one here. The date has changed now. It is 30th November. Okay. So time limit is 30th November or date of filing the annual return. So this was the old one. So the date will be 30th November. Let me change it here. 30th November of succeeding financial year or date of filing the annual return, whichever is earlier. Fine. So those are some important points which you have to remember. So just look at this provision point and see if you are able to answer this question. Hercules Machinery delivered a machine to XYZ in January under invoice number 49, dated 28th January for 4.15 lakhs plus GST, undertook trial runs. Amount chargeable for post delivery was covered in debit note raised in April for 50,000 plus GST. It did not file its annual return till October. What is the time limit for claiming the respective input tax credit? So whatever debit note is there, if it relates to the previous invoice, you can claim before 30th November or actual date of actual date of filing the annual return, whichever is earlier. Since he didn't file the annual return here, it is not very clear as to what is the date which you have to claim. So here you can say 30th November. Of course, if he files the annual return before that, that will be the tax return. Now, this slide is very, very important. This shows the respective evolution of the ITC mechanism in GST. So, this, I mean, just for your practical understanding. So, sir, we are seeing this GSTR 1-2A. Earlier, what was that? This sort of conditions was never there. Input tax credit you can claim if you have the invoice earlier, but now it is there. So, what exactly was the evolution? From 2001 to 2017, when the GST law first came into the picture, three types of GST returns were envisaged: GSTR1, GSTR2, GSTR3. GSTR1 was on supply, GSTR2 was claiming the input tax credit, and GSTR3 was sales minus GST on sales minus the GST on purchases. But what happened was the regular taxpayer found it very complicated to deal with. So therefore, GSTR2 never saw the light of the day. So therefore, it was only GSTR1 and GSTR3B. Earlier till 2019, if you had the tax invoice, you could claim the input tax credit. You should have had the tax invoice and you should have made the payment. Till Finance Minister Mr. Arun Jaitley was there at that point of time, he was never particular on what was being reflected in your 2A or 2B. For him, there is also a tweet which he has made at that point of time where he clearly mentioned that GSTR 2A or 2B was only for facilitating information. So therefore, if you had the tax invoice and you made the payment, you could claim the input tax credit. 2019 onwards only this linkage point started. 2019 to 22, first they started with 20% variation. That is, whatever is there in your 2A, you can, and whatever you are claiming as per 3B, 3B can be more by 20%. Slowly they reduced to 10%. Then they reduced to 5%. From 2022 onwards, total linkage with GSTR 2B, only if it is there in 2B, only then you can claim. If you want to change that or increase the credit, that variation will be marked in red in the GST portal and will invite the litigation, and government will start sending notices as to why you claimed when it is not reflected in your GSTR 2B. Fine. So therefore, let us see what exactly is happening here. By way of an example, supplier A sells goods, products worth 1 lakh to dealer B. These are the examples what I was talking about. Please go through these examples, very important, because it is not there in your supplementary paper. I had made these examples for you to understand the concept. Supplier A sells products worth 1 lakh to dealer B. Both are registered under GST. Rate is 18%. Supply took place during Jan 2023. Supplier files the GSTR1 or IFF before February 10th, mentioning the GST number of dealer B. Once GSTR1 is filed, it is auto-populated in the 2B and again auto-populated in 3B of dealer B. So therefore, if you see here, the dealer getting the credit is totally dependent on supplier filing the GSTR1 on time and updation in GSTR2B. So therefore, how to ensure that the supplier files on time? You may hold the payment of GST. you make the payment, but don't pay the GST till it is reflected in your GSTR2B. Fine, because only if it reflects in a GSTR2B, you can claim the credit. So why do you want to pay the GST before itself? Please, so therefore, in the practical situations also, what I keep advising everyone, say that once only if you are able to see it in the 2B, only then you make the payment. Before that, you please don't make the payment. Fine. So that was your section 16. Before we go to section 17, let's take a small short break. Any queries here? Here? Sir, now the due date of taking ITC in respect of debit note, the date of issuing and not the date in relation to the debit note was issued. So though the debit note here was issued in April, it was relating to the invoice issued there. So therefore, we can claim, we can take as per the date of issue of the invoice. There is no problem. The debit note has to be issued within 180 days. Only then you can consider it for the previous financial year. Fine. Yeah. So I hope all of you understood this. So let's take a break of 10 minutes and we come back and discuss section 17, apportionment of credit and block. See you in the next 10 minutes. Yeah. Welcome back, everyone. So that was your section 16 with the multiple amendments, what we have seen. So now we come to the next important section from the GST law perspective is your section 17, which speaks about the apportionment of credit and also the blocked credit. So when I say apportionment of credit, it is whenever there is the taxable supply and exempt supply, how do we apportion the credit, the common credit which are attributable to both the taxable and exempt supply? How do we apportion that with regard to input services and also capital goods? So sometimes the taxpayer can use the capital goods for both the exempt and the taxable supply, or he may use the input or input services for both the taxable and exempt supply. In that particular situation, how you can apportion the credit is also covered by section 17. We also will read rule number 42, 43 and multiple other rules associated to that in along with the section. So first we see section 17 subsection 1, which speaks about the apportionment of credit concept. It says that where the goods or services or both are used by the registered person, partly for the purpose of any business and partly for other purposes, the amount shall be restricted to so much of the input tax as is attributable to the purposes of the business. So where the goods and services are there, or both are used by the registered person, partly for business or other purpose. So whichever is attributable to purpose of the business, the credit shall be restricted to that. Okay, how it is to be calculated and all, we will see the respective rules. 17 subsection 2, where the goods or services or both used by the registered persons, partly for affecting the taxable supplies, including the zero-rated supplies, or under the GST Act, and partly for affecting exempt supplies under the said acts, the amount of credit shall be restricted to so much of the input as is attributable to the said taxable supplies, including the zero-rated supplies. So 17 subsection 1 says that if you use for business and you use for other than business, whichever is to the for the respect of the business, it will be restricted to that. Second one, it says that where the goods are used for affecting the taxable supplies, including the zero-rated or the exempt supplies, the amount of credit shall be restricted to so much of the ITC as is attributable to the said taxable supplies. Again, how we have to do this? Rule number 42 and 43 are the respective rules which cover this respective particular item. Fine. So that is your 17.1 and 17 subsection 2. So what all you will consider as exempt supplies as may be prescribed? What all shall be included? So when you say it is attributable to exempt supply and taxable supply, what is covered in the exempt supply is important here. So exempt supply here is supplies on which recipient shall be liable to pay on reverse charge basis, right? So when you are making any supply to a particular recipient, you don't collect the GST from them, but he pays it on the reverse charge basis. You make the supply to them and he pays it on the reverse charge basis. So that also will be coming under the exempt supply on. Transaction in securities on the shares, etc., that is also will be covered under exempt. Sale of land will be covered under exempt, and sale of building subject to 5B of Schedule 2 works contract. So sale of building subject to 5B of works contract. What does it say? We have seen the Schedule 2 very clearly. Sale of the building will be exempt provided the entire consideration is received after the issuance of the completion certificate or occupancy certificate. If anything is issued before the completion or occupancy certificate, then it won't be exempt supply. So sale of building subject to 5B of Schedule 2 works contract has to be covered. Fine. So these are your exempt supplies. I hope it's clear. So supplies on which recipient pays on reverse charge, transactions in securities, sale of land, and sale of building, right? For the purpose of the subsection, expression value of supply shall not include the value of activities or transactions specified in Schedule 3, except those specified in paragraph 5 of the said schedule. So whatever is activities are given under Schedule 3, exempt supply shall not include that. Exempt supply is on which it is zero rated, but neither a supply of good nor a supply of service. So that will not come under exempt supply because it is not at all a supply at the first place. That is your 17 subsection 3. Now 17 subsection 4 speaks about an option given to a banking company, including NBFC. Now, if you see, a banking company gives multiple services by way of extending the loans or advances or accepting the deposits, etc. So in this particular situation, this banking company can go as per the regular provisions, or it says that I'm not, because majority of the banking company services are exempt supply. Fine. Some are taxable, some are exempt. So it may either comply as per the provisions of 17 subsection 2, or the option which is given to them is every month you take an amount equal to 50% of the eligible ITC on inputs and capital goods every month, and the said shall lapse. So every month you will take the amount equal to 50% of the eligible ITC. So whatever is the ITC which is there as per GSTR, to that extent 50% you will claim, and the rest shall lapse. So rest you cannot claim, only to the extent of whatever is given in 2A, 2B will be able to claim 50% of that, and the balance shall lapse. So some other provision which is given here, once you exercise an option, you will not be able to withdraw the option for the rest of the financial year. The restriction of 50% shall not apply to the tax paid on the supplies made by one registered person to another registered person having the same. This is nothing but the interbranch supply of services. So interbranch supply of services, whatever taxes you are collected, that you can claim. For that, there is no restriction of 50%. And once you exercise an option, you have to make sure that option you don't withdraw for the rest of the financial year. These are the two conditions which you have to satisfy with regard to the option given to the banking company, etc. That is your 17 subsection 4. No, rule 42 and 43 are very much there. It's not omitted. It's very critical rule. In fact, there's no way they will omit that particular rule. It's very much there. Now, another very, very important section from examination point of view, please make a note, very important section, the input tax credit not available in certain cases. See, GST has given the facility of claiming the input tax credit on a very liberal basis. The GST law says that the input tax credit can be claimed on capital goods, inputs, input services, etc. But also, this particular facility, there is also a risk of misuse. So when I say risk of misuse, they may say that even though you can claim the respective input tax credit for certain particular expenses and particular items, you should not claim the input tax credit, because there is no clarity whether these items you will use for the business or not. And some are very clear, it's only for personal purposes. So therefore, the 17 subsection 5 covers a list of expenses, a list of items on which whatever GST you are paid, you cannot claim the respective input tax credit, because it is a blocked credit. It is a credit is blocked from the GST. You cannot claim it no matter what. Fine. So let us look at the item one by one. First one, motor vehicles for transportation of persons having approved seating capacity of not more than 13 persons, including the driver, except when they are used for making the following taxable supply. So what is motor vehicle for transportation of persons, he says. So that means first point here, important here is, it clearly says transportation of persons. So therefore, if any motor vehicle is there for transportation of goods, on this you can claim the input tax credit. So motor vehicles for transportation of persons having approved seating capacity of not more than 13. So not more than 13 seating capacity should be there. You cannot claim the input tax credit. But except when they are used for making the following taxable supplies. So following taxable supplies, if they make, they can claim the input tax credit. What are those? First one, further supply of such motor vehicles. That means if a motor vehicle is purchased and that motor vehicle only is supplied again, like any vehicle dealership for that matter, purchase and sale of the motor vehicles, then of course you can claim the input tax credit. Second one, transportation of passengers. That is, you are purchasing a motor vehicle and you are providing the transport services, right? Like you are using it as a cab, rent a cab services. You are purchasing the motor vehicle and you are using it as a rent a cab services. That means in that particular situation, if it is a rent-a-cab service, then you can claim the input tax credit. If you're using it for transportation services, you can claim the input tax credit. And the third one is imparting the training on driving of such motor vehicles. So therefore, if such motor vehicles you are driving and you are operating a driving school, you are purchasing the motor vehicle, and in that motor vehicle you are giving the learning facilities, like you are operating a motor driving school where such vehicles are used, you can claim the input tax credit. So I hope A is pretty clear to everyone as to what is subject to ITC and on what you cannot claim the respective input tax credit. Then AA has been again introduced. It was introduced later, somewhere in the year 2018. Similar to motor vehicles, even vessels and aircrafts. Okay, vessels is your ships, etc. Your vessels and aircrafts, except when they are used, okay, for making the following taxable supplies. So vessels and aircraft, whatever is being purchased, okay, on this also you cannot claim the input tax credit. But if you use it for the following taxable supplies, you can claim. First one, very similar to the previous provision, further supply of such vessels or aircraft, or transportation of passengers, imparting the training on navigating such vessels, or imparting training of flying of the aircraft. And the second one, for transportation of goods. So if you are purchasing the vessels and aircrafts for transportation of goods, then you can claim the input tax credit. So I hope this point is clear. Okay. See, very similar to motor vehicles only. Same thing is covered here, but this relates to vessels and aircraft, because there was a confusion earlier, because the section clearly said motor vehicle. So whether it covers only motor vehicle or other forms of transportation also. So that is why the 17 subsection 5 AA was introduced, wherein vessels and aircrafts are clearly demarcated and given. Then 17 subsection 5 clause AB talks about multiple services on which the ITC cannot be allowed. So what are the services which are there here? First one, now here these services are in relation to what is mentioned in clause A and clause AA. That is what is covered in AB. So the following services in relation to A and AA are also, you cannot claim it. What are that? The services of insurance, general insurance, servicing, repairs and maintenance, insofar as they relate to motor vehicles, vessels or aircraft referred to in A or AA. So anything related to motor vehicles. Again, this clause also was added in 2018. Initial when GST law came, this was not there. Why it came later? Because there was a confusion. Okay, you said purchase of motor vehicle. What about the insurance every year I take for motor vehicle? What about the repairs and maintenance I take every year for motor vehicle? What about that? It is very clear, very clearly clarified. On those also, you cannot claim any input tax credit. It is very, very clearly given that on those also input tax credit came. So what all is covered here? General insurance is covered, servicing is covered, repairs and maintenance is covered. On all this, you cannot take the input tax credit. Okay, but there is a provision which is there here, where the motor vehicles, vessels and aircraft are used for the purposes which are given in A or A. That is nothing but your further supply of vehicles, imparting the training and all. In that particular situation, you can claim the respective input tax credit. So I hope this point is clear with regard to general insurance, servicing, repairs and maintenance. Fine. So all this you have to remember, because it may be asked in the examination. Navigating vessel means traveling, like navigating the ship. Okay, like driving the ship, you can say. Then the following supply of goods or services or both also, multiple supplies are here given here. On these also you cannot claim. First one is food and beverages, outdoor catering. Okay, food and beverages, that means you go to a restaurant and you eat the food. On that you cannot claim any input tax credit. So even though it is for your business, like for example, if you are taking all your employees outside on lunch or a dinner, so that is basically food and beverages. So even though it is, you can see, you say that is for the purpose of business, it is related to my company expense, nothing doing, straight away it's a blocked credit. So food and beverages blocked. Similar outdoor catering also, if you take an outdoor catering event for if you organize a function for all your employees, outdoor catering you do, that also is exempt. Exempt. I'm sorry, it is a block credit. Beauty treatment. You go for a beauty treatment at a salon, you cannot claim the GST. It is not pertaining to your business. Health services, cosmetic and plastic surgery, leasing, renting, or hiring of the motor vehicles, all this you cannot claim the input tax credit. So all this you have to remember. Renting or hiring of motor vehicles, vessel, aircraft referred to in A or A, except used for the purposes specified therein. That means if you are renting the motor vehicles and you are imparting the training, then it is allowed. Okay, for the purposes which is mentioned in A and AA, if you are using for that, then you can claim. Then life insurance and health insurance also is there. So what all are covered here? Food and beverages. Okay, first one, remember that. Outdoor catering, very simple. Beauty treatment. When I say health services, you go to the gym or you go to some spa, all these come under health services, all those you cannot claim. Cosmetic and plastic surgery, leasing, okay, leasing, renting or hiring vehicles, etc. And also life insurance and health insurance also you cannot claim. Fine, very, very important points. All this you have to recollect because it can be asked in the form of a problem here, right? There is a provision which is given here. What does this provision mean? It means that where the ITC is available, where the inward supply is used by the registered person for making an outward taxable supply of the same category of goods or as an element of taxable composite or mixed supply, then he can claim the ITC. Now, what does this mean? It means that wherever this input tax credit is there, if you are using that as for the purpose of making outward taxable supply of same category of goods, example here. Now, what you do is food and beverages is there. Now you are into catering services. You are organizing a catering for a function where multiple food items are there. Particular food items you don't make, so therefore you procure. Let us example, you procure some sweets from a renowned sweets vendor, and you are using it as a part of your outdoor catering services. Then whatever GST you pay on the sweets, you can claim as a credit. Why? Because the inward supply is a part of the outward supply what you are giving. I hope you understood the respective point. Fine. So therefore, in all these particular situations, you cannot claim the input tax credit. I hope these are clear. You have to remember this in a, maybe definitely asked in your exam, a problem based on this particular point. Fine. Next one. So continuation is there here. Membership of a club, health, fitness center, also you cannot claim the input tax credit. Travel benefits extended to employees on vacation, such as leave or home travel concession. Okay, travel benefits, whenever employee is going on vacation, on that any GST is there, you cannot claim the input tax credit. Then also provided that input tax credit is in respect of goods or services are available, where it is obligatory for employer to provide under any law for the time being in force, then it should be available. That means what it says that wherever goods or services where it is obligatory for the employer, sometimes the law says that in some cases the employer has to provide insurance for the employees. So if it is given obligatory insurance, in that case the GST input tax credit can be taken. Then the works contract service, it talks about where the supply for construction of immovable property other than plant and machinery, except when it is an input service for further supply of works contract service. So therefore, what does this mean? When I am procuring works contract service for construction of immovable property other than plant and machine. Simple example, construction of a building. Okay, I am hiring a contractor, I am paying him for the purpose of construction of the building other than plant and machinery. I cannot claim an input, I cannot claim that as an input tax credit. But if I am using it for further supply of works contract service, then let us take two examples here. First thing, I am constructing my one building. I am constructing one building. Okay, for that I am procuring the works contract service. And like I am procuring a contractor, he gives me a particular contract, labor, etc. Everything he or me does. I am constructing this immovable property. I cannot claim the input tax. Second example, I am a contractor myself. I am a contractor myself. What I do is I am engaged in pure construction service for someone. So I get a contract for construction. I construct the building and give it to that particular person. So in the course of providing this works contract service, I hire another subcontractors, etc. Then I can claim the respective input tax credit. So I hope this is clear. Works contract service. Then goods or services or both received by a taxable person for construction of immovable property other than plant and machinery on his own account, including when such goods or services or both are used for the furtherance of the business. So, whenever you are receiving the goods or services for construction of immovable property on his own account, that means I am constructing an office building for myself. So, I am procuring some goods or services for that, for the construction. Then I cannot claim the input tax credit. Even though the goods or services are used for furtherance of business, it doesn't matter. Straight away, totally blocked. So clarification also is given that for the purpose of above C and D, construction includes reconstruction, renovation, additions or alteration to repairs to the extent of capitalization to the said immovable property. Then goods or services or both on which tax has been paid under section 10, composition scheme on which you have paid the tax, you cannot claim the input tax credit because only 1% has been paid by the seller, 1% or 2% or 5%. You have not paid anything, so it doesn't matter. Then goods or services or both received by a non-resident taxable person, except on goods imported by him. Okay, goods or services which is received by non-resident taxable person. Non-resident taxable person, he just undertakes a business when he is in India. So at that point of time, when he procures the goods or services, on that no input ITC will be available. But if any goods are imported by him, then the ITC will be available. Then goods or services are both used for personal consumption. So you are purchasing something which you are personally using, like say a deodorant or something like a perfume or shoes or shirts. Some people come and ask me, I'm buying formal shirts for my going to my office. Why can't I claim input tax credit? Is for the purpose of the business. You cannot say that because it is for your personal consumption. You are wearing formals or you are wearing shirts and trousers because you feel that it will give a visibility, but you cannot say that it is for the business. So therefore, this is also blocked. Then goods lost, stolen, destroyed, written off or disposed or by way of gift or free samples. So any goods which are lost, any goods which are stolen, destroyed, written off, disposed of by way of gift or free samples, these are all input tax credit is not available. And any tax paid in accordance with provisions of 74 on account of fraud, 1 to 129 section, you will see all this in penalties and prosecution chapter. Detention of goods, and 130 is confiscation of goods. All that if you're paying any tax with respect to all these particular points, the input tax credit will not be available. There is some change in section 17(5)(b)(1) in respect to renting or leasing, heading 5 of supplementary material. We'll go there. I'll just take the study with supplementary material. We'll just complete this and then we'll go to the supplementary study material. Okay. Which one was that? 17(5)(b), renting or leasing. Yeah, maybe because that e-commerce operator is there, because of that collateral amendments would have happened. We'll check that once we cover this. Okay, so kindly try to work out this problem. ABC is engaged in manufacture of heavy machinery. Company procured the following items during the month of July: electrical transformers to be used in the manufacturing process, GST paid 5.2 lakhs, trucks used for transport of material 1 lakh, raw material 2 lakhs, confectionery items for consumption of employees working in the factory 25,000. Determine the amount of ITC available with ABC company for the month of July by giving the necessary explanations. Please try to answer this question. Any answers? One is allowed because it is used in the manufacture. Other than it's a transformer, okay, which is like a plant and machinery here. Trucks used for transport of material also is allowed. Why? Because only transport of passengers, as I told you, motor vehicles is not allowed. Transport material very much allowed. Raw material very much allowed. Fourth one, confectionery items for consumption of employees working in the factory. That is, this comes under food and beverages, totally blocked under 17 subsection 5. 17 subsection 6 again speaks about the apportionment of credit. So the 17 subsection 6, what does it say? The government may prescribe the manner in which the credit referred to may be attributed. So therefore here it's just prescribing. You straight away have to refer to the respective rules to decide how the apportionment has to happen. Also, clarification with regard to plant and machinery has been given. With regard to, for the purpose of this chapter, the expression plant and machinery means apparatus, equipment, and machinery fixed to the earth by foundation or structural support that are used for making outward supply of goods or services or both, and includes such foundation and structural supports, but excludes land building or civil structures, telecommunication towers, and pipelines laid across the factory premises. Fine. So clarification is given as to what is plant and machine, because on procurement of plant and machine, the ITC is available. So therefore, what is plant and machine, it is given. Exclusions are also given here. Land building, telecommunication towers, and pipelines are exclusions given to the same. Then we come to rule number 38, claim of credit by banking or financial institution. As I told you, in this particular situation, banking or financial institution, how to claim the input tax credit, rule number 38 has given the respective procedure for that. Okay. So whichever is banking or a non-banking financial company which is engaged in supply of services by way of accepting the deposits or extending the loans or extending loans or advances, that chooses not to comply with the provisions of 17 subsection 2. That is, it does not go as per the regular provisions, but wants to claim as per the rule given, which is nothing but the 50% of the eligible credit. So following procedure has to be followed. First one, it will not avail the credit of tax paid on inputs or input services that are used for non-business purposes. Any inputs or input services we are procured for non-business purposes, we should not claim the respective input tax credit. You should not claim the credit attributable to the supplies specified in 17 subsection 5. In GSTR 2 now is no longer relevant. So whatever is there, ineligible credits which is given in 17 subsection 5, you cannot claim that. Inputs used for non-business purposes, you cannot claim that. And then the said company or institution shall avail the credit of tax paid on input or input services referred to in second proviso to 17.4, not covered under clause A. So whatever inputs and input services which is there in second provision to 17.4. What is the second provision to 17.4? Inter-branch supply of services. So when banking company, there is a taxable supply between two branches. Okay, between two branches, that you shall claim the input tax credit clearly. Totally you will claim. After you claim the total input tax credit of that, whatever is the remaining input tax credit. See, first of all your input tax credit will be visible in your GSTR 2D. The emphasis and the responsibility is on the taxpayer to segregate the ineligible and blocked credits and reverse them in the GSTR 3. Okay, to give you an example as to how it will happen. Okay, see, let us take this understanding is very important for you. Now, let us say Mr. A is engaged in supply of ready-made garments. Okay. Now, Mr. A purchases raw material worth rupees 1 lakh, and on this 18% GST is applicable. So GST is 18,000. Okay. Then Mr. A purchases a motor car, okay, worth rupees 10 lakhs, okay, 18% GST. It can be 28 also, rate is 28 for certain cars, so for luxury cars. But for this example, let us assume it is 18, 1,80,000. Okay, now Mr. A updates his GST number with both the above suppliers. So amount reflected in GSTR 2B is rupees 1,98,000. So will he claim the entire amount which is given in 2B? What do you say? Yes or no? Amount is reflected in 2B. Supplier filed his returns. So once it is reflected in 2B, amount will automatically appear in GSTR 3B also. In GSTR 3B under ITC column. So can he claim this? I want responses here. So can he claim this entire 1,98,000? He cannot obviously claim. He cannot obviously claim. So what he has to do? The responsibility on Mr. A is to reverse the ineligible credit. This reversal also will be done in the GSTR 3B on. I hope you got the point. This is what has to be done. So here, based on that, now let us read this NBFC column. So NBFC is very clear. Whatever non-business purposes, you will not claim. Whatever ineligible, you will not claim. Not claim is what? You have to reverse it because it already appear in your 3B. Then what you will do? You will claim the credit interbranch supply of services totally you can claim. Then 50% of the remaining amount of ITC shall be ITC available. Balance will be reversed in the GSTR. I hope you got the point. Claim only 50% and total related interbranch services, others, everything you reverse it. Fine. So therefore, this D is no longer applicable because the situation has changed now. Earlier, ITC will never be auto-populated in GSTR 3B. You have to enter it manually how much you can claim. But now it is auto-populated in 3B. So once it is auto-populated, it doesn't mean I can claim everything. I can claim only which is eligible and for the purpose of the business. Whichever is ineligible or blocked, you have to drop that. I hope you got the point. Now we come to rule number 42. Before I go to rule number 42, any queries till now? Subject goods received by the recipient. That is correct. I wanted to focus on how you have to practically reverse the input tax credit. Rule number 42 talks about the manner of determination of ITC in respect of inputs or input services and reversal thereof. So therefore, two things are to be identified here. First one, partly used for business and partly used for other purposes. That is point number one. The second one, partly for taxable supplies, including zero rated, and partly for exempt supplies. Okay, these are the two situations which we will arise. First one, partly used for business and partly used for other. Second one, partly used for taxable supplies and including zero rated, and partly used for exempt supplies. Fine. So how you will attribute this shall be done in the following manner. Fine. So I hope you got the point. Two circumstances is covered here. Okay. Two circumstances. Okay. First one is partly for business and partly for others. Second is partly for taxable. Again, this taxable includes zero rated also. Okay. And partly for exempt. These two circumstances, how to determine what is the input tax credit you are supposed to claim and how much is to be reversed. That is what we are going to see in the respective rule. So this rule number 42 covers everything. Sir, instead of taking as it is from 2B and reversing, we can manually edit. No, don't do that. Don't do that. See, manually, if you edit the ITC, Always there will be a situation where the ITC as per the 2B and 3B will be different. Don't do that. The gross column, make it the same. Reverse the ITC down. You have separate columns as per rule 42, 43. If you are familiar with the GST portal, down you have separate columns, ineligible ITC. Okay, ineligible ITC, one separate column will be there. Then down you will have reversed under 42, 43, one column will be there. So if you have such beautiful columns, there you have, better you do that. That is advisable, and that is the way you're supposed to do. Okay, I hope it is clear. Okay, so now let us go to the respective rule. So rule number 42, first thing, we have to calculate the total input tax involved on input and input services. Let us please denote it as T. Okay, total input and input services tax you have to do. Let us denote it as T. The amount of input tax out of T attributable to inputs and input services intended to be used exclusively for purpose other than business. Let us denote it as T1. Okay, please you have to get these rules very clearly. Only then you will be able to solve the problems based on this. Total input tax, that is ineligible, blocked, everything put together is T. T1 is whichever input tax you are using exclusively for purpose other than business. That is for other than business purpose, like non-business or personal use or whatever. Let us denote it as T1. T2 is the inputs and input services used exclusively for exempt supplies. Exclusively whatever you are using for exempt supplies, please denote it as T2. Okay, and T3 is the amount of input on which the credit is not available as per 17 subsection 5. As per 17 subsection 5, whichever credit is not available, that you please don't denote it as T3. So T1, T2, T3, these three you please first identify. Then the amount of input tax credit to the electronic credit ledger shall be denoted as C1. Okay, C1 is nothing but whatever credit you take to the credit ledger, which is nothing but the total input tax credit minus the sum of T1, T2, T3. I hope you got this point. So therefore, first you have to identify the total input tax, which is T. Out of that, you remove the input tax for exempt, remove the input tax for non-business, and remove the input tax for blocked credits. Fine. After you do that, you deduct it from the total input. That is, first you credit that to the credit ledger of the registered person. After you do that, find out the amount of input tax credit which is used exclusively for effecting the supplies other than exempted but including zero rated. I hope you got the point. Okay, understand the input tax credit which is used for supplies other than exempted but including zero rated supplies exclusively. That is eligible input tax credit, but we exclusively for supplies other than exempted and including zero rated, that is T4. So find out this T1, T2, T3, T4, and this you have to declare clearly in your GSTR 3B in the summary level, total of T1, T2, T3 and T4. So once you get this, you will find out what is known as your common input tax credit. What is common input tax credit? It is nothing but C1, which is your credit. From that, you remove the credit exclusively used for taxable supply. So C1 minus T4 is nothing but your C2. Once you get your C2, you will find out the ITC attributable to exempt supplies, which is denoted as D1 here, E by F into C2. That is turnover of exempt, aggregate value of exempt supplies by the total turnover into the C2, which is the common credit. You will get D1, which is nothing but the credit attributable towards exempt supplies. Okay, once you get that, you have to we'll continue here. Once you get that, there's a provision here, we'll come back to that. But As of now, you will first get the input tax credit, which is attributable towards exempt supply. After that, there is a provision which is given. What is the provision? Sometimes the input tax credit will be there, but for that particular month or that particular tax period, there will not be any turnover. Okay, of exempt turnover is not there. So what has to be done? So provided where registered person does not have any turnover during the tax period or aforesaid information not available. So how you derive the value of E and F? You will take the value for the last tax period for which the details of the turnover are available. Okay, so for the last tax period for which the details of the turnover are available, you will take, and based on that, we will take the T by F and calculate the respective credit which is to be reversed. For the purpose of this clause, it is clarified that aggregate value of exempt supplies and total turnover shall exclude the amount of any duty or tax levied under 84 or list of 7th schedule. So therefore, when aggregate value will not cover the GST which is charged, right? So therefore, the GST will not be covered in the aggregate turnover. Only the basic taxable value has to be taken into consideration. So let us continue our discussion here. So once you find out the D1, which is nothing but the credit attributable to exempt supplies, post that, what you do is you have to calculate the amount of credit attributable to non-business purposes, which is nothing but wherever the common inputs and common input services are used partly for business and partly for non-business purposes, you have the rule says that you take straight away 5% of C2. Okay, 5% of common credit, because here there is no way of understanding how much is commonly used for business and commonly used for non-business. For exempt and taxable, there is a way of doing it. You take the turnover, take that proportion and close it. But here you cannot take the proportion. So straight away what you do is you take the common credit into 5% of that, take as D2. So D2 will be the credit which is used for non-business purposes. Once you arrive at this D2, the remainder of the common credit which is there will be the eligible input tax credit attributed to the purposes of the business and for affecting the supplies other than the exempt supplies, but including the zero rated supplies, which is C3. So therefore, once you arrive at D1 and D2, whatever is the remainder credit will be nothing but the eligible credit attributable to the purpose of the business. So therefore, C3 is nothing but C2 common credit minus D1 plus D2. You will get the balance of input common credit, which is actually used for the taxable supply and zero rated supply. And once you get these three ones, C3, D1 and D2, you will indicate separately for the purpose of input tax credit and shall be declared in form GSTR 3B or DRC 03. DRC 303 is a form where you yourself declare the respective items and reverse the credit. So in case you don't declare in 3B, you can also declare in the DRC 3. Then once this is declared, the reversal has to be done up to the aggregate of D1 and D2. You will reverse it by the registered person in GSTR 3B or through form DRC 3. Fine. Provided where the amount of input tax credit used partly for purpose other than business, partly for exempt has been identified and segregated at invoice level, the same shall be included in T1 and T2. The remaining amount shall be included in T4. So how much you have used for exempt, how much you have used for non-business. Once you arrive at that at invoice level, the same you should include in T1 and T2. Whatever balance will come in the T4, whatever formula what we have discussed before. Fine. So after you do all of this, you will find the input tax credit. Finally, you will calculate for the financial year before the due date for furnishing the return of income, return for the month of September, following the end of the financial year to which the credit relates in the manner under the specified. Now, what happens is, now if you see, if you go back to this D1 and D2 here, okay, let me go back here so that you get the clarity. See, this D1 is totally dependent on the exempt term for that respective tax period. Okay, I hope you got this clarity. Please follow me very carefully. Okay, so here this D1 is totally dependent on the exempt turnover. Similarly, the D2 is dependent on nothing but C2. Now, this you do it for every tax period. At the end of the year, okay, at the end of the year, you will finally calculate whatever the amounts with respect to D1 and D2 is there. And you will calculate as per the sub rule 1. That means what? After the end of the year, every month you have calculated D1, D2, D1, D2. Based on that, you did the reversal and payment of tax. After the end of the tax period, you have a clarity with regard to what is the exempt total turnover for the entire year and what is the total turnover for the entire year. Similarly, common input tax credit for entire year, you have clarity. So what you do is, first you total all the amounts which has been claimed. That is point number 1. And the second is, you just make as per the facts actual D1 and D2 what is to be coming. You do the total at the invoice level. So that is what this particular sub rule say. Where the aggregate calculated finally, once you get the D1 and D2 for the entire tax period, it exceeds the aggregate which is there under the sub rule 1. Then whatever excess is there, he will reverse, the registered person shall reverse it in the GSTR 3B, but there is a time limit which is given. You have to reverse it before the month of September following the end of the financial year, and also interest also will be paid from the first day of the April of succeeding financial year till the date of payment. Second situation, where the aggregate amount of amounts determined under sub rule 1 is more than what is calculated finally, then excess amount you can claim as a credit. As per sub rule 1, totally whatever you have claimed is more than the month wise whatever you are calculating, the excess amount shall be claimed as the input tax credit for the month. Again, this also September is the date which is given for that. So what are the main important points here we have seen is ITC can be availed and utilized for payment of tax on the output supply. Okay, on the output supply it will clearly be calculated, and consequently you cannot claim the avail the ITC when tax is not payable on the output supply. On exempt supply, ITC cannot be available. Exception to this is the zero rated supply. Taxable person is making both the taxable and exempt supply, he will get full credit of ITC and capital goods, and no credit which is exclusively used for exempt supply. If common input services, common inputs and capital goods are used, then proportionate ITC will be available. What are the situations requiring? As I told you, when goods or services are used partly for business, partly for other purposes, goods or services partly for making taxable supplies and zero rated, and partly for making exempt supplies, apportionment is required. Now, a registered person is in the business of manufacturing shoes. He gave 50 pairs of shoes to his friends free of cost. Now, though this is not whatever he's in the business of manufacturing shoes, he gives 50 pairs of his shoes to his friend free of cost. So what happens to the ITC here? 17 subsection 5 says is, given as gifts or free samples, you will not get the input tax credit. So therefore, in this particular situation, input tax credit will not be available. Then registered person manufactures product X chargeable to 18% GST, product Y nil rate, product Z exported without payment of tax. All three products are manufactured from common inputs and input services. ITC on inputs here, because for product wise exempt supply, will not be available. Some examples with regard to this credit which won't be available. So these is the steps. This is how you have to work out in a problem. Multiple problems have been asked in the past on this particular concept. So it is very, very important for you to understand. We'll also work number of problems, so there will not be any issue on this one. Okay. So total input tax you will take. From that, you will reduce the input tax on input services intended to be used for non-business purpose T1. Then exempt supplies also input tax you will reduce. Ineligible credit T3 will remove. From this total T1, T2, T3 you will reduce, get C1, that is ITC credited to the credit rates. From there you will remove T4. T4 is nothing but the ITC on input services. which are exclusively for taxable supplies, including zero rated supplies, T4 you will remove. You will get the common input tax credit available for apportionment. That is your C2. Okay. Then this T1, T2, T3 will be declared at summary level, and whichever ITC for non-business exempt supplies, same will be added to T1, T2, and the portion which is pertaining to taxable supplies will be allowed as the input tax credit. Let us take an example here with regard to this particular rule number 42. Let us make an assumption here. Hawaii slippers are exempted. Case of easy footwear, manufacture of 2 varieties of Hawaii slippers and 5 varieties of other sandals and shoes. Dyes are used in manufacture of footwear. However, bright pink is used only for one of the Hawaii varieties. Black is used for sandals and shoes. Blue and yellow are used for all varieties. Brown is used for non-business purpose. Now, step 1 is as under. Inward supply input tax on brown dye, rupees 10,000 rupees. Now, this brown, if you see here, it clearly says it is used for non-business purpose. So whatever input tax on brown will straight away go into T1. Then he says the bright pink is used only for one of the Hawaii varieties. That is, since Hawaii varieties is exempt, it will come under T2. So this 90,000 will be totally blocked. T2 it will come. Then if you see here, black is used only for sandals and shoes. That means this is used only for exclusively for taxable supplies. That will be T4 here. So that is nothing but your 40,000 rupees. Then blue dye, blue is used for all varieties. So that is a common credit, and yellow also used for all the, that is also common credit. So what is the total input tax? All this comes under input tax only, which is 2,55,000. From this 2,55,000, you will reduce this, what all you will remove from that? You will remove T1, you will remove T2, you will remove T4. So once you remove these particular 3 points, you will get 1,40,000. So 1,15,000 is left out. That is your common credit. I hope you understood this example. So once you get this common credit, you will get 1,15,000, and you have to find out the credit attributable to exempt supplies. How do we do that? It is nothing but D1. D1 is equal to E by F into C2. So you know what is C2, which is 1,15,000. And based on this, now assuming the turnover of Hawaii slippers is 3 crores and the turnover of other supplies is 2 crores, 3 by 5. So 3 by 5 into 1,15,000, 69,000 is basically the credit attributable to exempt supply. That is, out of the common credit, 69,000 is related to exempt supply. For non-business purpose, how do we do that? It is nothing but 1,15,000 into 5%. Okay, because 5% is straight away given in the rule, that is 5,750. So you have got D1 and D2. So you remove this D1 and D2, 5,750 plus 69,000, which is 74,750. You remove from 1,15,000, you will get 40,250 is your eligible credit. So once you get this, 40,250 is the eligible credit, you will reverse the D1 and D2 what you have calculated. This is a small example in which how do you calculate the respective rule number 42. So after you do this, what do you do at the end of the year? Okay, at the end of the year, what you have to do? Compute C3 separately for ITC. Then for the entire year, for the whole financial year, you will calculate the D1 and D2. Once you calculate the entire year D1 and D2, if it is more than the amount already added to the output tax liability every month, so that is D1 and D2 is the ineligible credit. So if you see here, D1 is for exempt and D2 is for non-business. Once you, every month you have to do this exercise. So after at the end of the financial year, you'll have to do the total D1 and D2 for the entire year, taking the exempt turnover, total turnover for total year. Once you get this particular total, you have to compare. So if the total D1 and D2, okay, is more than the amount which you have added to output tax liability, that means excess you have to reverse. So 1% interest you have to pay till the date of the payment is excess you have to pay. Whatever amount you have added to the output tax liability is more than the actuals. So whatever amount you have additionally paid, you claim back by way of a credit. There is a due date for this, not later than September in the next financial year. You have to claim the respective credit. No, November is extended for the ITC claiming. For this, it is not accepted. For this, is continues to be September only. Okay, for this particular rule number reversal of credit, it continues to be September only. No, capital goods is not covered here. Capital goods is a separate rule, rule number 43, what we are going to discuss now. Yeah, I hope it is clear. So I hope rule number 42 is clear. Rule number 43, we come to this. So we'll discuss the rules at length and then we will do the problems. If time permits, today we will do one or two problems, or we will take up the problems in the next session. So rule number 43 speaks about the determination of input tax credit in respect of capital goods. So the main difference between rule 42 and 43 is 42 for inputs is pretty straightforward, but for capital goods is not that straightforward because of the concept of useful life of capital goods. Okay, so therefore reversal of capital goods, because to some extent they have used, then you have to reverse the credit. So therefore the concept of useful life comes into the picture with regard to the calculation of the ITC with regard to the capital goods and reversal thereof. So for the purpose of GST, okay, for the purpose of GST, we have to assume one thing, that the useful life of the respective for the purpose of capital goods is 60 months or 5 years is to be considered. That is what is the rule which is given in 43. Okay. First, let us go through the rule as always. Subject to the provisions of 16.3, the ITC in respect of capital goods which attract the provisions of 17.1 and 2 is nothing but the apportionment. That is, one is partly used for business and partly for other purpose, or partly used for taxable supplies and partly for exempt supplies, shall be attributed to the purpose of the business or for effecting the taxable supplies in the following manner. Namely, first one, the amount of ITC in respect of capital goods used or intended to be used exclusively for non-business purpose, or used or intended to be used for effecting supplies, shall be indicated in 2B GSTR form, GSTR 2B and GSTR 3B, and shall not be credited to the electronic credit ledger. First one. So whenever the inputs on capital goods is there, which is used for non-business purposes, it will be there in the GSTR 2B and also in the GSTR 3B, but will not credit to the electronic credit ledger. Second one. Amount of input tax for capital goods used or intended to be used for effecting supplies other than exempt supplies, but including zero rated, you take in 2A and 3B and also credit to the electronic credit ledger. Fine. So these two first you have to do. Non-business purpose, don't take in electronic ledger or credit ledger on. You would exclusive for taxable, you take in the electronic credit ledger. Whatever the amount of input tax in respect of capital goods which are not covered in A and B, let us assume it is A. Okay. Now, please understand very clearly. Non-business purpose, first one, don't take the credit. Second one is taxable supplies. It is there. In this particular situation, taxable supplies, it is there. This you take the credit. Apart from that, whatever credit which is left out in the GSTR 2B or 2A, assume it to be A. That amount you take in the credit ledger, and useful life of such goods should be taken as 5 years from the date of invoice of such goods. So whatever date of invoice is there, from there for a period of 5 years, you assume it to be the useful life. Provided, now this is very, very interesting. Where capital goods earlier covered under A is subsequently covered under B, input tax in respect of the capital goods denoted as A shall be credited to the electronic credit ledger. What does it say? What does it say? Earlier, any capital good is there which is used for non-business purpose. Later, that capital goods is now used for both non-business and business purpose. That is the common. Then what do you have to do? Then you have to straight away again take that also as A and credit to the electronic credit ledger. But there is a condition here. What is the condition? The ineligible credit attributable to the period during which such capital goods were covered under A, that is, you should assume that as TIE, which is nothing but T ineligible, shall be calculated at the rate of 5 percentage points for every quarter and added to the output tax liability. What does this mean? Earlier, these capital goods were under non-business. Now it came under business. So to that extent, the input tax I am now taking in the electronic credit ledger. But a point what you have to do is, at the point when it was the capital goods were relating to the non-business purpose, whatever is the ineligible credit which was there at that point of time, you have to calculate that per quarter 5 percentage points apply and add to the output tax liability wherever the credit is claimed. So then this ineligible credit you have to calculate for SGST, CGST, IGST. Once you calculate this aggregate A with respect to common capital goods, denote that as TC, which is nothing but the common credit, where any capital goods which is earlier under B are covered under C. That means earlier it was taxable, exclusively used for taxable, but now it is common. Then the input tax credit claimed, you should arrive at that also and get the aggregate value TC. Once you get this TC, you have to divide it by 60 months. As I told you, we are assuming the useful life of the capital goods to be 60 months in this case. Once you calculate the TC common credit, divide it by 60. That is per month, how much input tax credit attributable you will get. Okay. And as I told you, this I have already mentioned, 5 years is the useful life. And amount of the credit on common capital goods whose useful life remains during the tax period is TR and shall be TM for all such capital goods. So whatever input tax credit at the beginning of a taxable period, some common capital goods which useful life is remaining, it is to be donated as TR. So once you get the common credit point, that is your TE, once you get the common credit here, you have to donate it, multiply it by E by F into the common credit attributable to exempt supplies, where TE is E by F into TR. So once you get TR, which is nothing but the common credit, which is attributable both to non-business, business and exempt supplies, you take the turnover and work out the common credit attributable to exempt supply. Once you do this aggregate value of exempt supplies and F is the total turnover, in that particular situation, you will arrive at what amount of the credit of capital goods pertains to the exempt turnover. Okay, this provision is similar to Rule 42 only, where no turnover is there, last period you take into consideration. Okay, this is pretty much similar to last one. Then whatever TE you get along with the interest will be added to the output tax liability. It will be calculated independently for these. Some explanations are given to rule number 42 and 43, like value of services by way of extending deposits, extended loans and advances, where it is represented by interest or discount consideration, all that, and value of supply by way of transportation of goods by vessel from customs station to place outside India, it shall exclude. So these two items will not be considered wherever you are determining the aggregate value of the exempt supplies. Capital goods will also include the plant and machinery as defined in the explanation. We saw what is the definition of plant and machinery which is given. It will cover that also. Then for determining the value of exempt supply, as per 17.3, value of land and building shall be taken as the same as adopted for the purpose of paying the stamp duty. So the sale of land and building, wherever you are taking that as exempt turnover, you have to take the value for which stamp duty is paid. That is the government value on which the stamp duty is paid is to be taken into consideration. And value of the securities, because the securities also will be huge amounts. It will be purchase, sale, huge amounts. So therefore that entire amount, the trading purposes you cannot claim because it is of a speculative in nature. So the rule says that wherever the sale of securities is there and you have to work out the exempt supply, you have to value is to be taken at 1% of the total sale value of such security. Fine. So these are the steps which you have to inform. Just go through these steps now. It may appear a bit complicated now, but trust me, when we're doing the problems, you'll get total clarity. Fine. So how do we identify? First, you identify the input tax on capital goods used exclusively for non-business or making the exempt supplies. Then identify exclusively for taxable supplies. Then whatever it is not covered under above two, denote it as A. Initially, which was above, subsequently got covered under clause 3, reduce 5% per quarter or part thereof, together arrive at the total credit. Once you get the total credit, initially which were under 2, that is initially it was taxable, later it became common, then you calculate it by reducing the ITC at 5% per quarter. First one you add, the compute it by reducing 5% per quarter. This one also reduce 5% and add such value to the TC. Fine. Then once you get that, determine the common credit is nothing but divided by 60 months. After you determine the common credit during the useful life for a taxable period, determine the common credit at the beginning of the tax period whose useful life remains. That is your TR. So TR is the common credit into E by F. You will get the common credit attributable to exempt supplies. You will add it to the output tax liability. Fine. So a small example based on this one. With the help of the information given above, in respect of a manufacturer for the month of September, compute the ITC credited to the electronic credit ledger for the month. Also compute the amount of ITC to be added to the output tax liability for the month of September. This is the figures. Try to answer this question. Please remember that T1, T2, T3, TE, you need not mention all those in the exam. Okay, if you remember the acronyms you mentioned, but go as per the concept and solve the problem, that is good enough. So here, please compute the ITC to be credited to the credit ledger and also the ITC to be added to the output tax liability for the month of September. Please try to answer this. Theory question, you cannot answer anything. Theory question, it will be all practical problems only from this. From this theory question, don't expect. 5% of what, Namrata? Which 5% are you referring to? Any 5% were there here? 5% ITC. See, basically, whatever input tax credit is there of whatever you're worked out here, at 5% per quarter, you have to reduce because it is the capital goods. Okay, 5% per quarter. ITC is 1 lakh per quarter, reduce 5%. That. Okay, so how do we work out this first one? Now, he is first asking ITC credited to the credit ledger. Then he is asking ITC to be added to the output tax liability. So let us look at one by one. So he has given the outward taxability of 70,000 of exempt goods. Now, capital goods used exclusively for outward taxable supply 2,000. So this will be taken in electronic credit ledger. Okay, this 2,000 will be taken in the, because it is exclusively being used. Full ITC is available. And then capital goods used exclusively for exempt supply not taken because it is not allowed. Then capital goods used for exempt supply and taxable supply 4,200. Okay, this is commonly used. So first, if it's commonly used, first you take it. First you take in the electronic credit ledger. Okay, and then you have to reverse it. So 2,000 plus 4,200, 6,200. You will take it in the electronic credit ledger. Okay, after you get the 6,200, you will have to find out the common input tax credit which has to be there. Now, what is the common input tax credit? So this one, anyways, exclusively it is used, so total input tax credit is available. But it's used for both taxable and exempt. 4,200 is there. So from this 4,200 divided by 60. Okay, this 4,200 divided by 60 is rupees 70. Rupees 70 rupees is basically the common credit for the month of September. Okay, I hope you got the point. So if you look at the solution here, This 2000 you can straight away take. This nothing you will take. This 4200 you will take. So total ITC 6200. Common credit you have to look only for this particular because this is used for both the taxable and the exempt supply. So divided by 60, 4000 divided by 60, common credit for the month of September is 70 rupees. Now, out of this common credit, how much is attributable to the exempt supply, which is nothing but E by F into TR. So in this particular situation, 70 rupees into E by F. What is exempt supply? 40,000. And total supply is 40,000 plus 70,000, 40 by 110. So 40 by 110 into 70. Okay. 40 by 110 into 70. I hope you got the point. Is 25.45. So this 25.45 is attributable to exempt supplies and shall be added to the output tax liability. Okay. So that was a problem based on rule number 43. So I request you to kindly revise what all we have done today, because we'll be working multiple problems on the input tax credit. So all of you should have the proper understanding with regard to what we have discussed today. So with this, we come to the end of today's session. So again, a few important points for you to remember is, first one, please go through what all we have discussed today, because input tax credit chapter is spread over 4 sessions, which is quite elaborate. So in these 4 sessions, we will be covering section 16, 17, 18, and the method of apportionment. We will also cover the shifting from regular to composition scheme. Exempt supply becomes taxable supply. How do you deal with the credit? Taxable supply becomes exempt supply. Multiple concepts are going to be covered. And we are going to do multiple problems. Because of the time dedicated, we can work out multiple problems. So I want you to get this chapter into grip very, very clearly. So it's very important that you understand the concept on the basis of which we can solve this particular problem. So I would recommend you to attend all the sessions of input tax credit without fail. Our first class was supposed to be on Wednesday actually, but I got there was a personal issue due to which I could not take that session. So that particular session on Wednesday, which was not covered, will be taken on Sunday morning. So today, so your following classes of input tax credit will be today, of course, the first class. The second class will be on Sunday morning, which is nothing but day after tomorrow, early morning, 7 to 10 a.m. will be the session. And after Sunday, Monday will be the evening session, 6 to 9 p.m. And then Wednesday also will be the last session on input tax credit. So therefore, totally Friday, Sunday, Monday, Wednesday, these are the 4 sessions dedicated to input tax credit. I would request you to kindly attend the session because it is very, very critical for you to understand. So rule 43, no problem. We'll cover that again one more time. Let me just open give you the sharing access. One second. What was your doubt? Let's see. So rule 43, when non-taxable becomes taxable and vice versa, not clear. Non-taxable becomes taxable. Let us see one minute. Let's go back to that. First, identify this non-business purpose, tax used exclusively on non-business purpose. Then tax on capital goods exclusively for taxable purpose. Whatever other than these two, it is common credit. Now let us go to, this is the first one what you didn't understand. Initially covered, that is non-business or exempt purpose, gets subsequently covered under 3. That is, earlier it used to be a restricted credit totally. Now it became a common credit. Okay. Then what you will do? You will calculate that A. Okay. Okay. Let us take an example here. Let us see capital goods purchased for this at rupees 10,000. Okay. GST at the rate of 18%, rupees 1800. Okay. Now this at that point of time it was purchased, that time it was not eligible. Okay. Let us say this was somewhere in September 2022. Okay. Now later from October 2023, or rather April 2023, it was used for both exempt and tax. Okay, understood? So now what you have to do? Earlier this 1800 was ineligible, but from April 2023 it became common. So when you are calculating this A, 1800 is the ITC. How many quarters were there? September 22. From April 2023 it became common. So July, August, September 1 quarter, October, November, December 1 quarter, Jan, Feb, March 1 quarter, April, May, June quarter or part thereof also considered as quarter. So therefore 4 quarters are 4 quarters, 10%, so 5% per quarter. So 20% of ITC you have to remove it. So from this 1800, remove 20%. How much is that? 360. So 1800 minus 360. How much does it come to? 1800 minus 1340. Is that correct? 1800 minus, I don't have a calculator. 1800 minus 360 is 1340 or 1440. So this particular amount you will get added to A. Okay. This particular 1340 or 1440, whichever 1440 will get added to A. I hope you understood now. This was the doubt of 1440, correct. Thank you, Kaushik. So did you understand that now? Non-taxable became taxable and vice versa. Not clear? Did you understand? Earlier used for non-taxable, later used for common. Okay. Okay. Second one also we'll see so that it is clear. Where capital goods initially covered under 2, that is initially, I'll just remove this. Initially it was used for taxable supplies. Now it is used for common. Initially used for taxable supply. Now it is used for common. Okay. Same example, let us take 1800. It was there. Okay. Initially 1800, which you have already claimed, which we would have claimed at that point of time. Okay. So from this 1800, same example you take 5% per quarter. You have to compute A. When capital goods initially covered under 2, subsequently gets claused under clause 3, compute A and add such value to TC. Okay. So therefore, here what you have to do, this 360 rupees, you will have to reduce it by calculating A, and that you have to add to the common credit. Okay. This you have to add to the common credit. This is earlier. This is what is happening. You are removing from the common credit. This one you are adding to the common credit, because earlier it was exclusively used. So 1800 versus the 20% you will remove. Okay. So by reducing 5%, 20% will remove. That 1440 you will add to TC. I hope you got the point. The 1440 same thing you will add to TC. Okay. So that was the second point. I hope you got clarity. Yeah, 1440, correct. I know, guys, it's 1440. I tried working it like in the childhood. We tried to do the manual calculations in the brain. So the 1340 was wrong. 1440 is the amount. Okay. So Kaushik, I hope you got the clarity. How that when it's transferred from one to the other, how you take that reversal and how do you work out the tax? Fine. Any further queries? Anything missed out? Fine. क्वार्टर एक बार वापस बता दो, 1 minute. I'll not leave you till you understand. September 2022. September 2022 you have purchased. Quarter or part thereof. What are the 4 quarters? April, May, June, July, August, September. So July, August, September. September also is a part of the quarter. So that 3 months also quarter you have to take. So here what are the quarters which are covered? July, August, September, 1 quarter. October, November, December, 2nd quarter. Jan, Feb, March, 3rd quarter. April or part thereof again. April, May, June is the 4th quarter. That is how 4 quarters come. No. It is purchased in September, but you have taken the credit during the month of September. You have taken the credit during the month of September or part thereof. Clear? Janvi also has the same doubt. I hope it is clear. Or part thereof also should be taken as the quarter. So even if part 1 month is there, you have to take that as quarter. Fine. Clear? Great. Kaushik is clear. Janvi, I hope for you also it is clear. You didn't respond saying it's clear. Okay. Anyways, I'm assuming that you are also doubt is clarified for you also. Okay. Okay, guys. Then thank you very much for attending the session. I would again request you to please revise the concepts. Very, very important. And let's meet on Sunday at 7 in the morning, and let us look at the continuation of this particular chapter and work out more problems. Okay. Thank you very much, guys. Good night. If there is 1 day of quarter also, you have to take 5%, Namrata. Correct. Yes. 1 day of quarter also 5% has to be taken, or part thereof. The significance of that phrase is that. Okay. Good night, everyone. Thank you very much. Let's meet on Sunday morning 7 a.m. Request everyone to revise. Thank you.